Good riddance to September. Live from Studio 2 at Bloomberg headquarters here in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. Kicking you off to the closing bell here in the U.S. We were actually looking at gains earlier in the session. Not seeing them right now. You can see the S&P 500 off by about 0.5%, snapping a two-day winning streak. We're going to end September on a soggy note, it looks like. You look at the NASDAQ 100, big tech faring slightly better, but still off by about 0.2%. Relatively quiet in the bond market. I'm going to take a look at the 10-year yield right now and call that unchanged, though. You take a look at these levels off the highs that we saw this week, but still 4.56%, extremely high near those 15-year highs. I wanted to look at the VIX for some reason. It's not doing too much. It's up a little bit today, Romaine. We're looking at about 17 handle or so.
Yeah, we talk about here the big global sell-off that we saw in stocks and bonds. We started the day with investors trying to put that on pause, but looks like the market's really not going to cooperate. The damage done for the month and the quarter pretty much in the books here. After hitting year-to-date highs in late July, the S&P and the NASDAQ down more than 6% since. The Russell 2000 down 10%. The Magnificent 7 not so magnificent at all. Remember, those tech stocks had rallied about 86% at one point here to start the year. But by the time we got to the highs in July, they're actually down since then about 7%. In fact, the only bright spots among the 24 S&P groups, energy stocks and insurers, which are up for a fourth straight month. Now, the catalyst that drove this type of market repositioning in September, that now shifts to what could be a new set of catalysts for October, including what seems the inevitable. Yeah, the U.S. federal government shutting down because the Republican-controlled House of Representatives can't find compromise on how to fund the new fiscal year that starts this Sunday. The implications, they are big. Hundreds of thousands of furloughed workers, no paychecks. New government-backed loans to small businesses, cut off. Drug approvals at the FDA, put on pause, and operations at the IRS and SEC are going to be skeletal at best. And what doesn't show up in the official economic data could certainly show up in a dampening of sentiment for investors, businesses, and households alike. That's the setup into a new month and potentially a new quarter here. Though we should point out it's not all bad news, Katie. We got a fresh batch of inflation data earlier today that did show that the Fed's preferred measure of inflation actually doing pretty well here. Maybe that could provide a little bit of an upward catalyst for markets next quarter.
And maybe that's what we saw earlier in the session, but you saw that enthusiasm quickly fade. You look at the S&P 500, it's down almost 5% in September. That is the worst month of 2023, going back to December 2022. We knew that September was going to be bad. Seasonally, it's the worst month on average, and this September was no exception. Of course, one of the reasons possibly why this September was so bad is you think about what happened in the bond market. It has just been biblical at the long end of the curve. Right now, you're looking at 30-year yields, you're looking at 10-year yields, and you can see that line has been going up and to the right really since May. But in September alone, that 10-year benchmark Treasury yield, it was up almost 50 basis points, Romaine. That has been a real hit to sentiment, and we'll see how these lines move if we do head into that government shutdown.
All right, let's kick things off here with Linda Duessel, Senior Equity Strategist over at Federated Hermes. And Linda, of course, as we wrap up, I think a month that a lot of people would like to forget, there are a lot of people really sort of looking forward here, whether it's seasonality trends, technical trends, or maybe just the idea that corporate fundamentals might actually see maybe a little bit more strength as we get deeper into the year.
Yes, hi, good afternoon, Romaine and Katie. Thanks so much for having me. It did prove to be the way we know September is to be. It was a tough month. And October, they say, is where bear markets go to die. Now, we're not in a bear market, but we could have some volatility yet in the month of October. And as you were suggesting, now we're going to have a government shutdown. And there are a lot of things people are worried about right now, to include the strikes that are going on, worries about the Fed continuing to raise rates, and how fast inflation's coming down. You mentioned PCE, and that's good. That's a good one because they look at that very, very closely. But when we worry about things, we build that into the market, and then we can get surprised on the other way when the facts come through. So we could very well be set up for a good fourth quarter, and that's where we stand at Federated Hermes.
Well, let's talk about, I guess, what makes that good. Do you think that, at least let's start with the equity market, do you think that we'll see, if that does sort of come to fruition, that we'll see a much broader type of rally in equity markets, or is this going to be another story about those Magnificent 7 big cap tech stocks?
Well, it all comes down to the earnings of corporate America. And of course, we're all going to wait and see. We're closing the books now for the quarter. We're going to wait and see how they tell us how they did. As we know, though they had negative earnings the first 2 quarters of this year, they surprised very much to the upside. We want to see that continue on going well. We were surprised very well, positively surprised by corporate profit margins. And to the extent we hear that across the board, that should be good news. And to the extent that we're a consumer-oriented economy and the consumer remains quite strong, we very well could get good news and across the board and get that breadth that we need to really reach the 5,000 level, which we're suggesting we can get before this year's end.
Well, even if we do get good news on the earnings front, how do you stack that up against what's happening in the bond market, and particularly if the bond market continues to sell off to the extent we saw this month?
Well, like you said, the bond market it's biblical what's going on in the bond market. It's really very, very interesting that you would see rates go up as quickly as what they're doing. Rates going up generally are a fear for inflation. We all think that inflation is coming down. Those who worry about a recession, well, then the long-term bond yields ought to be coming down. So they're going up and more than what people thought. And of course, this surprised a lot of people because we were at such low interest rates for such a long time. But you know what? If we get to the 4.5% to 5% 10-year government bond yield, and we look back over the last 20 years, that's a pretty average figure, pretty normal number. We've thought that, and we're hearing that more from other Wall Street strategists out there that, you know what, this is normal for a strong economy. But it is happening fast, I grant you that.
And I'm looking through your notes. You write that when a crowded trade breaks, it usually breaks hard. You think about what happened and what Romaine said was not the so magnificent 7. Is that what we witnessed over the past few months? Was that just positioning that had gotten over its skis?
I think so, yes. I mean, it's been called a craze. I've been doing a lot of study on it. It's for real. It's going to be great. But it's going to take some time to prove itself in the productivity numbers of all the various companies out there that will benefit. So it got extra loaded. And you said, I believe Romaine said, we were up 75%. We've given back 7. So what? That's been, you know, 3/4 of the performance this year has been this magnificent 7. That's okay, but as we all know, these growth stocks do not like high long-term bond yields. They're a long-duration asset, and if I may, when we look at what might break, the defensive stocks out there that are high-quality dividend-paying stocks that you might want to flock to if you were worried about long-term rates, they can't get a break. In fact, I just saw that utilities broke down again. Utilities, the defensive area that that you might want to take a flyer on, really. It's so very cheap. But that's not telling me that there's a recession coming ahead at all.
Yeah, it's interesting to see kind of that downturn you've seen there, given particularly, obviously, the income play that you get out of some of those stocks. Linda, great to catch up with you. Linda Duessel, Senior Equity Strategist over at Federated Hermes, helping us kick off to the close here on this soggy Friday afternoon in New York. And, of course, a very dour day down in Washington, a government shutdown looming. The economic consequences, we're going to hear from Mark Zandi at Moody's Analytics about the potential impact.
Plus, what a shutdown would mean for government agencies such as the Food and Drug Administration. We'll speak with Stacy, Amin, partner at Morrison Foerster. She was FDA's chief counsel during the 2018 shutdown. And
we're still keeping an eye on the auto workers' strike here in the U.S. The UAW said it's going to expand its strikes against GM and Ford, but it's actually going to spare Jeep maker Stellantis after a last-minute breakthrough. We'll update you on where we stand right now in those negotiations. All that and more coming up in just a bit. This is Bloomberg.
Let's take a closer look at the impact of a government shutdown on U.S. markets and, of course, on the economy. Now, in the past, shutdowns have only had a minor impact on the S&P 500, but Mark Zandi, chief economist at Moody's Analytics, says the impact will compound the longer the shutdown goes on. And Mark, I'm pleased to say, joins us now. And Mark, talk us through that. How long would the U.S. government actually have to shut down for this to really have a meaningful impact on the macroeconomic environment?
Well, Katie, I think if it's a typical shutdown, it's only 2 to 3 weeks, no big deal. I mean, obviously, it's a big deal for the government employees that are furloughed and not getting paid, but for the macro economy, for markets, I don't think it's that big a deal. If it's a month, kind of sort of like what happened back in 2018-19 under President Trump, that was the longest in history. Then you start seeing some cracks, people get a little nervous. But again, it's not kind of a macroeconomic event. But much longer than that, if you get into 2, 3 months, which sounds like a long time, and hopefully we don't go down that path, then I do think, lots of different things start to break in the economy because it relies on the federal government. And it will become a macroeconomic event, and it will impact stock markets and financial markets more broadly.
And Mark, if we stay in hypothetical land, if we say that the U.S. government does shut down for 2 to 3 months, how does that change the recession conversation and the probability of a recession?
Changes it a lot, Katie, particularly in the context of all these other headwinds the economy is grappling with, from higher oil prices, higher interest rates, the UAW strike, the end of the student loan payment moratorium. So lots of other stuff going on here. And if this shutdown drags on for a couple, 3 months, then we'll certainly get a negative Q4. And then if it does impact investor confidence and we see stock prices sell off and consumers start to grow anxious and start to pull back on their spending, then recession becomes a real threat. So the longer this drags on, it becomes 2, 3 months, recession risks are very clearly going to rise, and recession becomes more likely than not.
I am curious, too. I mean, when we talk about this idea of the potential economic damage from a shutdown, and we know that, at least in terms of the percentage points that would be shaved off GDP, still relatively minor. There's a longer-term issue here, Mark, that I'm sure you're aware of. The fact that we've been through this process, something like at least 10 times now in terms of the Congress not meeting their deadline to pass a budget. And it's obviously raised a lot of concerns, I guess, just about the effectiveness of Congress and whether that should be a bigger factor in how the ratings companies assess the rating credibility of the United States.
Yeah, you make a great point, Romaine. Of course, I'm not in the rating agency, so I'm not going to comment directly on the ratings. But, it's pretty obvious. I mean, if we can't keep the government open, if it shuts down, that goes to the poor governance, the dysfunction in Washington. And, of course, that's on top of the drama just a couple months ago over the debt limit, which was even more threatening. But here's the thing. I mean, we've got very serious long-term fiscal problems. I mean, if you look at the Congressional Budget Office forecast for the budget deficit and debt, and the CBO obviously is the nonpartisan group that does the budget for the government, under reasonable economic assumptions, under current policy, the debt to GDP ratio, which is what we should be looking at here to gauge fiscal sustainability, it's 100%. It's double what it was prior to the financial crisis. Yeah. And if there's no change in policy, we'll be at 115% 10 years from now, 180% 30 years from now. You can do your own forecast at that point. Yeah. And that's unsustainable. So I think this is just symptomatic of a broader issue.
Have you ever taken, a closer look, though, when we talk about making spending cuts, at least drastic spending cuts, like certain members of Congress want to implement here, what that economic effect is? I mean, it's easy to say, okay, let's cut this in order to balance our budget, but we also forget, of course, that fiscal spending plays a huge part in our economic growth.
Yeah, I mean, to address our fiscal problems, we have to do all of the above, meaning we do have to restrain government spending, and that goes to the mandatory entitlement programs, particularly Medicare and Medicaid, because that's kind of where the money is and where the growth in cost is going to be for taxpayers. But we also have to address taxes. We do need to raise taxes to generate the revenue that we need. And not all tax increases, not all spending cuts are made equal. The impacts on the broader economy, both near and long term, vary quite considerably. But so we have to really think about this. But that takes a great deal of effort, work, and we have to work together and compromise. And obviously, if we're shutting the government down, we're nowhere close to doing that.
Mark, always great to talk to you. Mark Zandi there over at Moody's Analytics here. A look at the potential economic consequences of the government shutdown. We continue that conversation as government agencies around the country now start to prepare for the fact that they might not actually be able to open their doors on Monday morning. The Federal Drug Administration could also be affected by that as well. The potential for reviews of new drugs to come to a halt. Stacy Amin joining us right now. She was FDA's chief counsel during the 2018 shutdown. She's a partner now at the law firm Morrison. Morrison and Foerster. Stacy, thanks for being here. And let's start off here with this idea of sort of how agencies sort of have to adjust to this. The idea that most of these agencies in some way or another will have some degree of operations, though it will be skeletal at best for most of them. Let's start with the FDA, since you have some experience there. What does a shutdown for the Food and Drug Administration look like come Monday morning?
Yes, I think the public has this misconception that during a government shutdown, that means employees are on a paid vacation that, eventually gets paid. That is definitely not the case at the Food and Drug Administration, which has two categories of work that the agency continues to do during a shutdown. One category is related to user fee funded work. FDA's medical product reviews, like drugs and biologics and medical devices, are funded through user fees. That work will continue for some period of time while the agency has carryover user fee funding available. There is the risk, like we faced with the 2019 shutdown, that if the shutdown continues for too long, FDA will not even be able to continue its drug and other medical product reviews. The other
okay, so on that point, and you can continue that thought there when you talk about the other categories, because I think I know where you're going with this. But they do have some provisions, I guess, to deal with emergency issues. So if, God forbid, we had another pandemic, they would be able to sort of shepherd another vaccine through. Is that correct?
That's right. And they do have, in fact, COVID carryover fees. So they are permitted to do a number of activities related to COVID. But even if there were another pandemic, that would fall into this category of accepted activities. And yes, that's where I was going with the other category of work that continues. And the Anti-Deficiency Act is the law that governs what work an agency can do during a shutdown. And that statute permits the agency to continue doing work related to the protection of human health. So certainly work related to a pandemic would fall into work to protect human life.
At a certain point, though, Stacy, does the FDA run out of funds? Assuming this shutdown extends long enough, what would that mean for the agency when it comes to its actual funds?
The agency can run out of funds. So for accepted work, the agency is expected to continue doing that work whether they have funds or not. And that's just activity that is related to the immediate protection of human life. So it's not most of FDA's work, which is, for example, drug product reviews. But FDA does very much risk running out of those funds that permit it to continue reviewing drug applications. And in fact, in 2019, we were faced with the very realistic possibility that FDA, for the first time in its history, would not be able to continue reviewing applications for new drugs. There's also a lot of activity related to the development of new drugs that the FDA cannot continue doing. And that does have quite a significant effect on the life sciences industry.
Yeah, well, talk to us a little bit more about that, because if you're in the industry, if you're a drug company, obviously you're very closely working with the FDA. What could it mean if this shutdown does extend past the 2-3 week mark?
Well, and even within the 2 to 3 week mark, there are companies that are being impacted right now that are not certain whether their meetings with FDA that are happening, for example, next week, are going to occur. So what FDA has been clear that work related to a pending submission can continue. But if you're a company that was planning to file your new drug application next week, you will not be allowed to do that. And if you have a meeting with FDA next week, or 3 weeks or 4 weeks from now, that's important to the development of your drug product, there's a lot of uncertainty about whether that meeting can occur or not. And nobody really knows the answer to that. Only FDA will know, and that has not been communicated to the industry what work will continue and what won't.
All right, Stacy, it's really great to get your perspective. Appreciate your time on this Friday. Our thanks to Stacy, Amin, partner at law firm Morrison and Foerster. From New York, this is Bloomberg.
All right, a fresh slate of Wall Street firms, including Interactive Brokers and Baird, agreeing to collectively pay tens of millions of dollars to regulators over their employees' use of unmonitored communication channels on the job. Austin Weinstein joining us right now from Washington. And this is largely, Austin, I guess, about some of these brokers and traders going around their own internal controls at their banks using apps like WhatsApp to communicate when they apparently shouldn't have.
Exactly, yeah. Brokers face really strict SEC rules that say they have to retain all business communications for a long time. And if you're communicating on WhatsApp to a trader somewhere else, or if you're communicating on Signal, or even using your personal cell phone, and that is not saved and that's not monitored by your company, that's going to run afoul of SEC rules. And the SEC found that a number of firms today violated them quite regularly for quite some time.
Austin, is this the rest of our lives that every couple of months we read some headlines about another brokerage, another bank having to pay these fines, or how does this end?
Oh, Katie, it's felt like that for the last 3 years now. Every few months we see huge banks and huge settlements pay now $2.6 billion in fines to the SEC and the futures regulator for these. And as it seems now, this is going to continue. More and more companies, more and more investment advisors, PE firms, hedge funds, smaller brokers have said they're under investigation. Yeah. And the SEC has shown no letting up on these firms for their off-channel communications.
Well, it's good, I guess, that the SEC is trying to hold them accountable. When I see a collective penalty here of $79 million with the M, Austin, I kind of scratch my head and wonder, how does this even hurt these companies?
Well, that's a question that's been levied at the SEC's enforcement division for a long time. These are companies that will measure these fines in minutes, maybe hours of profit. And it's not going to affect their shares, as we saw today. Their shares are unchanged. And that was the case for even the largest banks, paying as much as $200 million, too.
Austin Weinstein over there in Washington. Here, a look at the latest news out of the SEC, a batch of fines going to a batch of companies for skirting around their own internal control systems. Meanwhile, here on the final day of the week, final day, trading day of the month and of the quarter, we count you down to the close with markets on the back foot once again, Katie. This has really been the story now. We started off pretty strong early in the session, but just not holding.
Yeah, maybe those PCE figures ignited some optimism in markets. It was quickly extinguished. And
how did you get to work today, by the way? Because I noticed your feet aren't wet. Last time I looked, there's like 4 feet of water. You took the subway. You know, the subway's underground.
I know. I took the subway at about 7 a.m. Things were still fine. I mean, I was on a local train and it did go express, but it worked out.
Oh, wow. First world problems. There you go. A look there at the streets of Manhattan. About 2:30 p.m. in the afternoon here in New York. Stick with us. Romaine Bostick and Katie Greifeld. This is The Close on Bloomberg. This is the countdown to the close. Let's get a check of the markets here. Equities on the back foot. Treasury's not doing a whole lot of anything, but with the energy space right now starting to show some activity. Abigail Doolittle, she's standing by right now with our commodities close. Abigail.
Yeah, commodities are taking a bit of a hit on this last day of the month and the quarter. You can see New York crude oil back at, or WTI crude, down 1%, just above $90 per barrel. Wheat really getting hit, down 6.6%. Corn as well. So there's some real weakness for the grains in particular. And then silver down 1.8%. So a rough day for commodities on this last day of the quarter. On the quarter, however, it's a different story, although it depends on what part of the commodity complex we look at. But overall, you can see the Bloomberg Commodity Index is up 4.6%. When you contrast that with the S&P 500, down about the same amount. This silo of risk assets definitely doing much better. It has everything to do with crude oil, though, up 30%. Really pretty incredible, the best of the year. But take a look at wheat, down 21%. Not down just here. On the year, down closer to 30%, heading to its worst year, I believe, since 2009. So commodities, a mixed picture, some good and some bad.
Yeah, of course, that was a huge story of the past quarter. It'll be interesting to see how much of a story that becomes for the fourth quarter. What we know is going to be a story over the next few days, if not weeks, is that United Auto Workers Union strike. That strike now expanding against GM and Ford to more assembly plants, but Stellantis, which makes Chrysler and Jeep vehicles, will be spared, at least for now, from additional walkouts after a last-minute breakthrough. UAW President Shawn Fain made the announcement in a live stream briefing. Take a listen.
Despite our willingness to bargain, Ford and GM have refused to make meaningful progress at the table. That's why I'm calling on an additional 7,000 members across Ford and GM to go on strike. We are not calling on any additional members at Stellantis to go on strike. Moments before this broadcast, Stellantis made significant progress on the 2009 cost of living allowance, the right not to cross a picket line, as well as the right to strike over product commitments and plant closures and outsourcing moratoriums. We are excited about this momentum at Stellantis and hope it continues.
All right, the head of the main auto workers union here now seeing that there is some progress with Stellantis. David Welch joining us right now, our bureau chief out there in Detroit. Didn't really have anything favorable to say about Ford and GM, though, David.
He did not. And it was a bit of a surprise because we thought there was progress over the past week at Ford. And I think there was. I think they're hung up on the future of workers who will be at battery plants, most of which are not built yet. And also its pension and retiree health care issues also loom very large at the moment. And that's at all three companies. But, you know, I think Stellantis made progress on cost of living allowance, which the company was probably trying to hold the line on earlier, and some other job security issues and like issues like the right to strike if the company wants to close a plant. Things like that is what Shawn Fain said. So he saw enough progress there to not strike a plant, although right up to the last minute, he was going to shut down a Jeep plant in Detroit.
And I want to talk more about your reporting that the UAW wants to emerge from these strikes with at least a 30% pay raise. That is down from the initial ask of 40%. Is there any indication that maybe the membership is getting frustrated with Shawn Fain, or what is the reasoning for that drop?
No, you have to put that in context. The initial 40% is something Shawn Fain himself called part of his audacious goals. Union didn't necessarily drop down to 30%. It's just strategically, they want at least 30 because they think, first off, that'll be more than enough to get ratified with the current membership, but also it's sort of a banner they can use with people who work at other plants, Tesla, Toyota, you name it, future battery plants, to say, look, we got a 30% raise. That's a big number. And you should join the union because we're good at securing strong contracts. That's really what that's all about. The companies are still kind of haggling somewhere in there, somewhere between the 20% the companies offered and the 36% the union had asked for on their second set of demands. They did come down from 40 to 36. I think they'll probably end up settling somewhere around the 30% mark, but it's not like the union has dropped and their counteroffer says 30%. It's just that's kind of as low as they would want to go because they've got this tactical thing that they want to be able to do after this is all over.
David, just for our viewers, can you kind of give a sense here with regards to how these auto plants work? If for some reason we actually are able to reach an agreement, how quickly are they able to get production back up to normal?
I would think a couple of days, but remember, it depends what the union wants to do. Sometimes the union has kept workers on the picket lines until the deal is actually ratified. Sometimes they don't. Depends on what Shawn Fain wants to do. And, you know, he could, as soon as there's a tentative agreement, as a sign of good faith, send the workers back. And then they would have to renegotiate if the workers didn't ratify the contract. I don't think that'll be an issue, honestly. What's on the table right now with more than 20% raises, including the cost of living allowance, is the best deal the union has ever gotten. So, you know, workers would look at this compared to the last three agreements and say, hey, they're getting well more than that. And those deals eventually passed. So, you know, it does kind of depend on how the union wants to run its own democratic process. But once that's up, you know, you're talking about cranking it up pretty quickly. It doesn't take a long time.
Yeah.
All right, David, really appreciate your reporting as always. That is Bloomberg Detroit Bureau Chief David Welch. And of course, there's been a lot of movement on the labor organization front that's happening next week, specific to the Actors Union and the Hollywood studios. They agreed to resume talks on Monday, October 2nd. Of course, the writers have already reached a deal. It's the actors that are left, and we'll see. It's good that they're talking.
Yeah, I mean, that's always the thing. I mean, when these strikes first start, of course, everyone's sort of all in their own corners and nobody sort of wants to give in. And the idea that they're at least they're able to sit in the same room and hash these things out, I guess, gives some optimism. But not to be a Debbie Downer, there's a lot of other strikes kind of in the pipeline as well, potential strikes, I should say, in the pipeline headline as well. So once we get past this, I feel the feeling we'll be talking about others.
Well, let's talk about Las Vegas right now. Las Vegas Culinary Union members, they actually voted to authorize a city-wide strike. This is according to a post on X. So we'll see. They're authorized now to call for a strike any day.
Culinary work. So these are like the cooks and the people who provide all the food at the casinos and hotels and stuff?
Yeah, there are negotiations continuing next week with MGM, Caesars, and Wynn Resorts. So we'll see how that shakes out. But still ahead on the close, before we get there, Chico's, it's surging this week after Sycamore Partners agreed to buy the clothing store company. We'll talk to the analyst, about why this deal makes the most sense for this brand. This is Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we're going to start off right now here with Brinker, the owner of Chili's and Maggiano's restaurant chains. Stiefel upgrading the stock to buy from hold, saying the new CEO's first year on the job, it's netted some quick wins here on operational changes, and says his turnaround strategy actually looks to be mirroring the success of turnarounds at peers like Olive Garden and Popeyes. Those shares having a pretty good day, up almost 3%. Let's stick with restaurants and take a look at Texas Roadhouse, raised to buy over at North Coast Research, with the analyst saying foot traffic in the third quarter appeared to be strong. He also raised his same-store sales estimate and says the recent decline in the shares actually offers some value opportunity for investors that want to take a bite. Those shares up about 1% on the day. And finally, Ball Corp upgraded to buy from hold over at Jefferies. The analyst citing a lot of improvements in the pop can maker's free cash flow and a favorable setup from proceeds after selling its aerospace unit last month. Those shares also having a pretty good day, actually one of their best days since June, up about 3%. And those are some of our top calls. We want to stay in the sell side space and take a look at M&A activity, particularly with retailers and particularly with Chico's. Striking a deal to be acquired by the investment firm Sycamore Partners, a deal valued at about $1 billion. Analyst Jeff Lick over at B. Riley praising the role of its CEO in orchestrating the deal, saying, quote, Molly Langenstein is essential to Chico's continued success, and if she's back in the Sycamore bid, another bidder would have limited interest without her participation. Jeff Lick joining us right now, senior consumer equity research analyst. He's got a buy rating on the shares. And Jeff, let's actually start with the CEO. I mean, she was specifically brought in a few years ago, I think from Macy's, to kind of turn this ship around. And I guess this deal is kind of the culmination of that. You're relatively comfortable with the price she was able to negotiate?
Well, yeah, that's correct, Romaine. She was brought in 2019 to, turn the ship around, as you said. And she's done a great job. Her and her team have done a fantastic job. They've taken EBITDA from about 75 million and grown it back up to about 150 million. And I think that it's a fair price or a good price for the shareholders, for the management team, and for Sycamore. I think it's a win-win-win.
Well, let's talk about here I guess, what they sell and who they sell it to. I was talking with my co-anchor because my sort of recollection of what Chico's was mainly geared towards older women, and she was kind of saying that there was a younger demographic that was also into it as well.
Maybe the 30-year-olds. I don't know.
Well, they have three concepts. They have the flagship Chico's concept, which caters to 45 to well past 60. They have the White House Black Market concept. That's it's a little of a hipper brand, and that caters to the 35 to 50-year-old. And then they also have a Soma brand, which is an intimate brand, which is a growth concept, and that's kind of across the board. That caters to a 30-year-old to a 60-year-old audience.
I shopped at White House Black Market in college, so I don't know, maybe that is unusual, but I'm looking through your notes and it seems like there's a lot to like about Chico's and their portfolio. And with that in mind, is it surprising that it took this long for someone like Sycamore to emerge?
Well, as we pointed out in previous notes, Sycamore actually made a bid for Chico's in 2019, first for $350, and then this is when, right before Molly was brought in, they took the bid down, believe it or not, to $3. So no, it's not too surprising that they're back. They've done a great. Chico's has done a great job of kind of reinvigorating the business since 2019, and it just makes a lot of sense for Sycamore given what they already own in the space.
And I like this point in your notes that Chico's is not and was never a struggling mall-based retailer. How did they build that moat? How did they insulate that from maybe some of the struggles in the broader retailing industry?
Well, you have to go back to where, Chico started. There's not a fast fashion retailer. They're really catering, to a customer that wants an outfit, that wants service, that wants style. So it's not fast fashion. As I pointed out in the note, 40% of the business is digital, 60% is, through stores. And they actually have an interesting kind of social selling dynamic where it's almost the equivalent of a Tupperware party. And so, the Chico's consumer is very passionate about the brand.
What do you think is kind of the future here in terms of once this gets into Sycamore's hands? What do you think the evolution might be of this brand?
Well, I think the brand will just continue on the same path that it's been on. As we were talking, before we went on here. The demographic profile is very favorable for the 35 to 60-year-old. There's that cohort is growing. Chico's, White House Black Market, and Soma resonate well. Sycamore already has Ann Taylor, Talbot's, and Lane Bryant in their portfolio. So, there's a good chance that you can see that coming public as a platform of companies in the coming years.
All right, Jeff, great to talk to you. Jeff Lick there over at B. Riley. A closer look here at Chico's getting bought out by Sycamore Partners here as they enter what could potentially, I guess, be a new era for this company. And I'm glad he brought up, the other brands under that brand. So obviously, Chico's, right? Mm-hmm. White House Black Market, which I'm also told is popular.
It's great, yeah.
And Soma. You're a Chico's fan?
I am a Chico's fan. I really like White House Black Market. They have a little bit of mission creep, as I was just saying to one of our producers.
Mission creep?
Yeah, they used to be only black and white clothes. And
okay.
I really
as the name suggested?
Yeah, but now they have,
decided...
I'm on their website right now. I see some purple sweaters. I see a pink blazer and stuff. So they've deviated a little bit.
Were you expecting them to just stick with black and white? I mean, there's a whole palette of colors out there.
I don't know. I think
not everybody wants to wear black and white.
There's a lot of blue sky when it comes to just black and white, so.
Katie Greifeld, fashion aficionado. Are you? But you're wearing green or teal.
I know someone
or blue.
picked this for me, but in any case.
All right, coming up here, when it comes to loans, economists, they're actually getting worried that students are borrowing too much. Interesting story on the Bloomberg terminal today. We're going to dive a little bit deeper into whether getting a master's degree is actually worth the steep price tag. That conversation coming up after the break. This is Bloomberg.
Well, student loan repayments are set to resume next month, and with increasing tuition and rising interest rates, economists are worried that students might be borrowing too much. For more, let's bring in Janet Lauren. She is Bloomberg's higher education finance reporter. And Janet, I'm reading through your piece, and you make the point that grad loans set to eclipse loans for college. Why is that happening? What's going on here?
So you're starting to see graduate school loans, the share of annual amounts taken for graduate school, about to eclipse undergraduate for borrowing. And there's a couple of reasons that this is happening. Number one, graduate students can borrow quite a lot of money. They can borrow up to the cost of attendance, which in some cases could be $80,000, and undergraduates are limited. Also, the interest rate is very high. This year, it's the highest in about a dozen years, over 8%. And keep in mind that the interest is accruing while you're in school. And the other concern that economists from the education department has is there going to be a premium for your job by borrowing all this money? Are you going to earn more money? And we had some statistics from a labor economist looked at job postings. And while more people have graduate degrees, employers aren't necessarily looking for graduate degree holders. They just want the skills that you'll be able to do that job.
All right, just get real world skills. School of Hard Knocks, Janet. I am curious about the increase in interest rates overall and how much that actually plays a factor into some of the decisions that a would-be MBA student or wouldn't-be grad student would make here. I mean, if you can get a loan in a zero-rate interest world environment versus one where you have a 5% baseline, that I would think that changes the dynamics a lot.
Well, for the last 10 years or so, the interest rates do change every year. They're pegged to the 10-year Treasury rate. So recently, they've been going up. So the question is, again, the interest rate is higher. Every year you take on a new loan based on a different interest rate, and it's accruing during college. So by the time you graduate and start paying off, you've already accrued quite a large amount of money. You just have to figure out and do the calculus. Are you going to a top law school or a top MBA program, or a very low-cost program where you're going to be able to pay off the loans? And, one thing we didn't get into in the story was, there's a bigger uptake in income-driven repayment plans, which are based on, what you're making. So more people are taking advantage of these programs with lower incomes. And that's a whole other issue. But are they paying off?
Well, Janet, that's what I was wondering reading this piece. I mean, there's certain professions where you need a graduate degree. If you want to be a lawyer, if you want to be a doctor, you have to go on to higher education. But the fact that some of these lower income tracks are also looking into that type of repayment structure, what kind of professions are we talking about there?
Well, if you're going to a top law school and you're borrowing a lot of money, chances are you're going to be okay. But if you're going to a law school that maybe is not quite the top, or frankly, at the bottom, and are you going to be able to get a job that you're going to be able to pay, more than $150,000, $200,000 in loans back? And you just have to really do the calculus. There are other low-cost programs out there, and keep in mind, you can borrow a lot of money. You don't have to, but the government gives you the option to borrow up to the cost of attendance, which includes housing as well, and living expenses.
I am curious, Janet, based on kind of the universities and the administrators that you talk to, are they significantly worried about this trend?
They're not, because they keep adding graduate programs. They're quite profitable for colleges.
Yeah. All right, Janet, another great story here on the Bloomberg Terminal. Janet Lauren, who covers high education for us. A great title there. Always great to talk to you, Janet. Have a wonderful weekend. And Katie, this does get to an issue. I mean, the trajectory, at least over the last few decades in this country, was you had to go to college and then get a grad degree if you wanted to make anything of yourself. And we know that's kind of been upended, not so much because if you don't get it, you can still have success, but the idea that a lot of people who got those extra degrees didn't necessarily find success, but they were still stuck with the bill.
Yeah, that's the thing. And I think it's an important point. There's certain professions you need one, but there's a lot that you don't necessarily need a higher education degree, such as journalism. I mean, I have a master's in journalism. Did I need it, though? I don't know.
No comment.
Did it benefit me?
Yeah.
Probably. I had a great year.
Yeah, but I like Janet's comment, too, about the idea that, they're not too worried about it because they just create new graduate programs. And you kind of forget, we should point out these schools are businesses, more or less. Even though they may be nonprofits or whatever, at the end of the day, they have to create sort of new things to keep people interested, and they'll find a way to adapt.
Yeah, and it's interesting to see how this will evolve to the point on interest rates, whether extremely high interest rates relative to history maybe saps some demand here, maybe has people rethinking about how many student loans I want to take out. And of course, just the fact that student loan repayments are starting up again. I mean, that's obviously a national conversation right now, and maybe that'll filter into decision making. Yeah,
well, let's go back here to the broader markets here. We're heading into the final hour of trading on the week, the month. The quarter, I'm told. Anyway, look, this was a pretty bad month, and we know that. It was not necessarily a great quarter either. Basically, if you bought energy stocks, you did well. If you bought anything else, you're probably in the red here. And a lot of that had to do with what we saw with rates. A lot of that had to do with what we saw with the dollar.
And it'll be interesting to see if this momentum continues to build, or whether this was just a typical September. Maybe this was a seasonally bad month. It's usually supposed to be, or whether this was the start of a regime change, at least in the market psychology, through the end of this year.
It's going to be interesting to see, because maybe if you get a resolution in some of these labor issues, if you get a resolution, obviously, on the government shutdown, then maybe does that provide a little bit more sunshine for this market, particularly heading into an earnings season that a lot of people think is going to be kind of the start of maybe a little bit of an upswing in revenue growth as well as profitability.
I'm excited to see these two narratives duel each other, because if earnings season is better than expected, but the Fed is more hawkish than expected, who wins? I don't know.
All right, stick with us here. We're going to try to answer some of your questions when we come back after the break. This is The Close on Bloomberg. Almost 3 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld.
Interesting setup here. Let's get a view from the top here on a very rainy day here in the Northeast, particularly in New York, and kind of a soggy day for the markets as well.
You know, I'm glad you brought up the weather. I know we have to talk about the markets, but the weather is terrible right now, and you can see that sentiment reflected in the market, though the S&P 500.
I love how you made that connection there, because all you've been doing all day is complaining about the weather.
It's crazy.
You got to work okay, though?
It was okay, but how am I going to get back from work?
Yeah, well, you can just stay, put in some extra hours.
That's true.
Hustle hard culture is, I think, what they call it.
Just work through the weekend, get prepared for the start of the fourth quarter trade. Of course, we are at the end of the quarter. I'm just leaping around here. The S&P 500, it is off the lows. It's actually unchanged now, Romaine, but not too much volume.
You kind of wonder, though, is the fourth quarter going to be any different? Are the catalysts going to be different in the fourth quarter than what we saw in the third? I think the Russell 2000 could hold some keys there, because we get to this idea of when we start to see a cyclical trade, a small cap trade, basically a broadening out of maybe some of the rally that we had earlier this year. If that comes to fruition, then maybe that gives people some hope. But at 4, 5, 7 on a 10-year yield, that might be an impediment. Flip up the board here. I'm gonna do something optimistic for you, Katie Greifeld, here. M&A activity, which is actually, we know, on a year-to-date basis, and this chart shows you, has been awful.
Right.
It's been down, but we had a couple big deals, a couple big $10 billion plus deals just over the last couple of months here in the U.S., a couple overseas in Europe, and there's the expectation that we could see more later this year.
And it coincides nicely with what we're seeing in the IPO market, which is signs of life. Of course, both M&As and IPOs have been pretty dry for a while now, but again, maybe we're starting to see some juice there. Let's talk about some of these individual movers, rather, not movies. That's for after the show. Tale of two earnings here. You had Carnival report. They posted a profit for the first time since 2020, but the fourth quarter earnings outlook, it missed expectations. We're talking about higher fuel, currency costs, weighing on the operations, shares down mightily, as to is Norwegian.
But this wasn't really a demand story. I mean, it seemed like revenue's holding up, or at least the growth rate is holding up. It's more just the extra costs that they have. And so you kind of wonder if at some point they try to pass that on to the cruise line.
Yeah, we'll see. And I mean, it's a good point that demand is still there. You would think that that would help some of the...
I saw you had Nike on that board. Now, I'm told that you aren't a Nike person. You're into Hokas, which are like those thick shoes.
I love Hokas.
They're orthopedic? They're for senior citizens?
No, they're for similar to Chico's. They appeal to really all demographics. I race in Nikes, but I love Hokas. But in any case, a lot of people really like Nike. Profit, inventory results that really ease some of the fears over demand. And I thought this was interesting. Revenue in China fell, but the CEO, John Donahue, said that sport is back in China. You can just feel it, Romaine.
Okay, I guess I kind of feel it. I mean, look, I think people were really prepared for the worst with Nike, and that's a big part of the reason, I think, why you're seeing the shares pop like this.
And cruises, they were some of the best performers on the year. Of course, the bar was higher.
Well, there's your pairs trade as we are an hour away from the closing bell. Stick with us. Our cross-platform coverage, counting it down to the close, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld, joined right now by our colleagues Carol Masser and Simone Foxman. Simone filling in today for Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms here on the final trading day of the quarter and of the month, of course, to be sure here. A soggy day in New York, Carol, and a soggy day in markets.
Oh, my God, right? Like, it's kind of weird. It depends on the hour that you look at the trade, and you maybe get a kind of a different tone, a different mood, a different trend line. Having said that, I'm thinking about the government shutdown. I'm thinking about how we might need some important economic metrics. So I'm thinking about Taylor Swift and the importance she plays in terms of the economy and kind of where things go from here. So
has she been appointed to a cabinet position or something?
She's not on the Fed board or the FOMC meeting, not quite yet. But what's interesting is those jet tickets the jet game between Kansas City this weekend at MetLife Stadium. Apparently, prices have gone up. And then there's a great story about the impact of Taylor's tour on the economy. It's big money.
Yeah, apparently the U.S. Travel Association saying that it's $10 billion is the overall impact of the tour. And of course, cities very invested in this too. If Taylor Swift comes to your city, I'm personally quite invested in this relationship. But
Are
also,
you?
Maybe it's we're all born in 1989, but Nike actually was asked about this in its earning call, and John Donahoe joking that both this as well as the Amazon Prime show Coach Prime are driving apparently some sales of jerseys. Nike, by the way, makes NFL jerseys right now.
That helps. I'll say what I said on Twitter when it comes to the Jets game this weekend. Maybe the Swifties just really want to see Zach Wilson. Maybe there's another story here, but I think it's Taylor's.
I'm curious. Is she contractually obligated to show up to all these games? Do people think that she's coming? Or are they coming to see Travis? I'm confused.
I don't think she's.
I think they're just expecting it because she was at the game last weekend.
And I think she's in New York, or she lives here, or spends a lot of time here. That's my
just the chance of seeing her when you want to.
Sounds like we need to go to the game. I don't know if anyone has tickets. I don't know. Hopefully the weather improves.
All right.
Let's move swiftly along.
How are you going to segue out of this, Katie Greifeld?
I'm not.
It's another economic measure or economic impact.
Yes, thank you, Carol. We're talking about Uber, DoorDash, Grubhub. The New York State Supreme Court declined to bar the city from implementing the New York City minimum, and as a result, these trio of companies and others have to pay their food delivery workers at least $17.96 an hour. So again, they had been trying to block this, and as you can imagine, the pushback from the companies has been pretty immediate and pretty harsh. DoorDash, it sounds like, and others are basically going to pass on these higher costs to customers such as you and I.
Well, it'll be interesting too. Because I feel like a lot of the fees that they charge now have already sort of gone up pretty significantly. So if you're adding in now, you have to factor in this higher wage cost. And we know that other jurisdictions are also considering something similar as well, particularly out in California.
I don't know about you. I would have paid my Uber driver this morning. I know this isn't apples to apples. I would have paid him $1 million just to get to the office this morning. No, but I do wonder about, whenever I look through the fees, I'm like, how much does this actually get back to the driver or the delivery person? And I feel like we are living in a time where we really need to have kind of a comeuppance when it comes to, let's make sure people are making a living wage. And I think these services are nothing without their delivery people.
That's right. But at the same time, I put a $10 tip on some of my orders. Do you continue to feel the need to do that if these drivers are getting $18 an hour?
That is a provocative question, and I'm glad you asked it, but I'm not going to answer it.
I was a waitress at one point. I get that it's important, but part of it was because they were just not making the same minimum wage, right?
What would Taylor Swift do? You think she's got to be a big tipper?
Remember, she paid her drivers who were all on the tour some really serious money.
She's a really good person.
These were Uber drivers, or
no?
She's going to save the world someday.
Yeah, and the economy.
And probably be head of the Federal Reserve.
It's putting a lot on her shoulders.
We can pray.
I think she just wants to make music.
All right.
Does she have another album to re-record?
This is how if she dates somebody, we get a new album.
Yeah.
That's why she needs
a catalyst. Yeah. In any case.
All right, guys, we're going to be back. We're going to wrap up the third quarter, one and done, and going to kick off the fourth quarter next week. But we'll be back at 4 p.m. Wall Street time.
She's done wonders for the cowboy boot market.
I believe it.
Everybody should have a pair in their closet. All right, join us at 4 p.m. Wall Street time for Beyond the Bell, our cross-platform coverage, counting you down to the close.
Our coverage continuing here on the close, right here on Bloomberg Television. A little more than 50 minutes until we get there. Larry Fink over at BlackRock actually spoke exclusively with Bloomberg earlier. He had some interesting take here on where Treasury yields might go. Take a listen.
My opinion is we're going to have 10-year rates at least at 5% or higher because of this embedded inflation. This structural inflation is unlike anything. And I think business leaders and politicians are not providing the foundation to help explain this. We have not seen inflation like this in over 30 years.
Larry Fink there, I think echoing the comments that we've heard from Jamie Dimon as well as some other big financial leaders saying that the path forward for rates is going to continue to be higher. Gennadiy Goldberg joining us right now. He's head of U.S. rate strategy over at TD Securities. And I guess we'll just start there. Where do you think rates are going to go? Do you think we're going to see a material difference here higher sometime soon?
So, I mean, the big question that I get is higher, but also for how long? 5%, is it a touch and go and we come right back down? Or are we talking about a protracted 5% or, as Jamie said, 7% interest rate? And if that's where we go, that's going to be very, very painful for markets, for the consumers. I don't think a lot of that's translated through yet, to be entirely honest. And the longer we stay at those higher rates, I know the Fed's been preaching higher for longer, but the longer we stay there, the more painful it gets.
Is this more, though, an issue in terms of the movements that we're seeing in yields? And really, this is more a question about price than the yields themselves. Is that more a reflection of concerns about economic conditions? Or is it more a reflection of supply issues? What's really driving this?
Oh, it's a great question. I mean, it's a combination of everything, to be entirely honest. I mean, it's supply, certainly, although I think less supply and more lack of demand, because supply is a little bit easier to quantify. Demand's a little bit more slippery. I think a lot of it's being driven by the Fed. So higher for longer is having its impact. The question is, higher for how much longer? Are we talking about 3 to 6 months? Are we talking about touching 5% or 6% and then coming right back? Or is this a sustained 5%? And I can tell you, you hit 8% on consumer mortgage rates, which we're right about to do. And what's the demand for mortgages going to look like then?
Yeah. It's going to dry up, I think, at least is the expectation. On August 22nd, you were on Bloomberg surveillance and talking about 5%. You were talking about it in regards to the 2-year Treasury yield. You said that 2-year yields at 5% is a pain trade for banks. Now we're just about at 5%, more than a month later. Is that still the case? What does this mean for the banking sector?
So, I mean, it's a protracted pain problem. I mean, if you look at bank losses overall, you look at bank losses just over the last quarter, and certainly Q3 losses are going to be pretty significant on their available for sale and their hold to maturity portfolios. We're actually worse than we were when SVB collapsed. And yes, there are certainly Fed backstops now, but the question is one of lending. Do banks continue to lend? And if you start to look at the lending numbers on a year-on-year basis, they're really slowing. So I do think these interest rates are actually having the intended consequence. It's with a lag. And I know the Fed talks about long and variable lags. And, we just don't know what those lags are, but we know they're longer than this. And in reality, real rates have only hit positive levels really since the start of the year. It's only been about, call it 6 to 9 months of positive real rates. The longer this stays, the more painful it gets.
Well, now real rates are positive and then some, and extrapolate that out into the broader economy. The longer that real rates are closer to these normal, very positive levels, what does that mean for this economy, which has gotten very, very used to negative real rates?
I mean, it just makes the cost of everything more expensive. So, we're complaining about the cost of food delivery, for example. We're complaining about the cost of, refinancing your home or your car or buying a home, for a lot of people. It does become much more expensive, and the longer it drags on, the more it crimps spending in other categories, and you'll have trouble actually seeing, people going out to eat. You'll start to see some of that slow down, and it's interesting because the question is, who pays for the extra pass-through to the worker? You guys were discussing wages earlier. Who pays for that? Is it us, the consumers, or is it the companies actually eating into their margins? What's been interesting in the last couple of quarters, you've seen company profit margins start to chip away. Now, they're still quite high and quite healthy, but the longer this goes, the more they have to pass it through. So either they pass it through to the consumer, or they pass it through by lower margins, and then the valuations start to look a little bit high.
What do you, I mean, this kind of might be a question you can't answer, but why do you think we haven't seen a little bit more of that? I know that as of late, we've seen some companies kind of say, okay, we've maybe gone as far as we can go with the price increases, but you really haven't seen a wholesale, like, okay, we're just going to finally just give a break to the consumer.
Well, nobody ever does anything out of the goodness of their heart. Right. And I think the companies try to give and take as much as they can. Yeah. And it's really a market, right? How much can you pass on to the consumer before the consumer walks away and says, you know what, I don't need your stuff. I don't need your service. I'm going to go across the street where there's a 20% discount and try to compete on that. You're seeing much more competition. If you feel like you've seen more sales flyers, that's because you have. We've seen companies actually starting to discount a little bit more and try to pass through some of those costs in sneakier ways than they have in the past. But I don't know if we're necessarily going to see them just wholesale give up, but it's really a kind of a chipping away at those profit margins that over time are going to become a lot more painful to sustain.
And when we think about sort of the path forward from here, I just want to end on what kind of levels that we're going to be talking about. Is 5% realistic, or is this just an academic discussion when you think about the 10-year Treasury yield?
So the way I think about the long-term Treasury yield, and I know you had Bill Dudley write an op-ed about this a couple months back, it really depends on how you break it down long-term. And just to keep it simple, we're talking about long-term level of interest rate in real terms, the inflation target, and term premium. The big question is about two of those things. We know the Fed's not going to touch that 2% long-term inflation forecast. So is it 1% R-star? Is it higher than that? And is it 0% term premium as we've gone to now? Is it more like 1% as Bill Dudley was noting? So it really depends on where that is. I see a long-term 10-year rate at around 3.5%. I don't think we're actually up at 5% on a sustainable basis, unless inflation continues to really roar through the system. And that's something the Fed's really trying quite hard to avoid.
Yeah, and it'll be interesting to see whether we do shift into maybe more structural inflation or whether the Fed really does have this under control. Gennadiy, really appreciate your time and you coming to studio in the rain. That is Gennadiy Goldberg. He is head of U.S. rate strategy over at TD Securities. Now, coming up on the close, we'll speak with Professor Jeremy Siegal of the Wharton School at the University of Pennsylvania and get his insight on how a government shutdown would affect the markets.
Plus, we're going to take a look at what's going on in the apparel space. Nike shares having their best day of the year after their quarterly results indicate demand still strong, what it means for other companies in the retail sector.
And the end of an era, at least for Netflix DVDs. All that and more coming up. This is Bloomberg.
Welcome back to The Close. It's time now for our Muni Moment and a look at interest rates rising and, well, a look at how a government shutdown could affect the municipal market. Eric Kazatsky joining us right now, senior U.S. municipal strategist with Bloomberg Intelligence. And Eric, everyone's trying to sort of assess what a government shutdown is going to mean for the economy. Let's go local with this here. Are you anticipating that there could be a material effect in the municipal market?
I wish I had something exciting to share with you. We've gotten this question probably 20 times over the last 2 weeks, and unfortunately, there's really not going to be a huge impact to our market. I know it's boring, but for our market, that's actually a really good thing because it means stability. At the end of the day, you have some federal subsidies coming to some borrowers, very small portion of our market, but the good news is credit is really positive still. A lot of state and local issuers still have those cash piles from the pandemic to sit on, so that will get them through.
Okay, so maybe nothing to panic about there, but what I could panic about, if I take a look at your notes, you note that actually muni returns, they're now in the red for the year. And if this persists, first back-to-back periods of losses since the 80s. It feels like things haven't been that bad in the muni market, but then you take a look at the size and scope, and it sounds a little alarming, Eric.
It is alarming, right? I mean, this is sleep-at-night money for the large majority of holders of municipal bonds. And I think over the last 2 years, it's been really surprising for folks to get their statements in the mail and see losses. So now we're going to head to a period where we might have our second back-to-back period of losses, since 1980 and 1981. But we're looking at the silver lining here and saying, coming into that 1982 period, we had outsized gains. So even if we have losses this year, we're hoping we repeat that pattern again.
So, okay, we repeat that pattern again here. There is this idea here, too, though, that the issues that we've had with supply for a good portion of the year, what is actually that breaks, I guess, out of that trend? I mean, is there some sort of real need for more issuance, meaning from the municipalities themselves, that we could maybe hang our hats on going forward?
Look, there's always a need for issuance in our space. There's a certain amount of spend that needs to get done on the state and local level just to keep the lights on, the roads fixed, stuff like that. And that's not getting done right now. Have you seen the roads in New York City? I've seen them today.
Okay,
you guys are going to need to issue some bonds now.
Yeah, I don't know where that money is going, but okay.
Exactly.
Sure.
But the problem is you've had rates tick higher, so a lot of state and local governments and other issuers in our space are reticent to borrow at these rates. They think that the Fed's going to ease coming into next year. And that may be the case, it may not, but things still need to get done and financed. I think what the shutdown does is definitely going to delay some projects that have federal monies attached to it. So that is unfortunate for our space.
And Eric, talk to us, though, about the next 3 months. Of course, we're heading into the final quarter of the year. Of course, we could be looking at the first back-to-back losses in quite a while. But what is your baseline expectations? What does the next 3 months look like for the muni market?
I think best case scenario, we're going to drift sideways and, basically clip our coupons. I think if we finish off the year right now down about less than 2%, I think we can consider that a huge victory. I think a lot of folks took a lot of losses over the last month, over 3% in losses, and they're going to be reticent to really take on some risky positions over the next several months. Coupled with that, we've seen new supply issuance tick down a little bit. Given where rates are, that makes a lot of sense. So, best case scenario, we coast.
All right. Eric, great to catch up with you. Eric Kazatsky, stay dry out there, senior U.S. municipal strategist for Bloomberg Intelligence from Morrison, New York. We'll be back in a moment. This is The Close on Bloomberg.
Well, Romaine, it's the end of the red envelope era. After 25 years of Netflix, they're no longer mailing DVDs to their members. Of course, about 16 years ago, they gradually shifted their focus to streaming content online, which, of course, is the business now. I'm kind of surprised, though, that it took so long to phase out the DVDs.
To phase out the DVDs, and we kind of forget just how actually revolutionary this was. I mean, can I just talk about the struggle? The struggle back in the days of having to walk to a store, look around, walk through aisles, try to find a videotape or a DVD that you wanted to watch. Then you had to bring it back a few days later to avoid a late fee. You were lucky if it was on the shelf. Netflix kind of made that simple. And I mean, who knew they were going to grow into basically the Hollywood behemoth that they are here? But it was quite revolutionary, and then it was even more revolutionary when they did make the pivot to streaming.
And now you think about sort of the struggles of the streaming industry. It feels like Netflix is one of the only ones that really has it right, where it's really working. But yeah, they were pioneers in both senses.
Do you know what the first DVD that Netflix ever shipped out?
I didn't scroll down that far in the article. Tell me.
Well, I'm surprised you just didn't know. Beetlejuice.
Really?
Yeah, that was all the way back in March of 1998.
I would not have guessed that.
I want to find out what the last one they shipped, because they said they're shipping out the last one today, which I'm just curious. Who of you out there is still getting DVDs in the mail? But I would be curious to see who that person is and what that sort of last DVD. That has to be like a collector's item, right? Like, I feel like if I knew I was the last person to get the last DVD, I would never return it, right? I just pay the penalty, and you could probably
arrest me?
I don't know. It's Netflix. They are pretty big.
The Netflix police. Yeah, I'm sure there's some super fans out there, some super collectors. There's a great article on CNN that has some few film fanatics, self-described, who have really are sad to see this go. But I think the broader population is.
It's the most popular DVD ever.
Yeah.
Was Sandra Bullock in The Blind Side.
No.
Which, of course, now a somewhat problematic movie now that we know in hindsight.
A tainted
what
legacy.
That is. But anyway, if any of our fans out there are doing this, and we do have a lot of fans, Katie Greifeld, including Phoebe, hello, out there to you. We are rounding out here into the final 30 minutes of trading here on this Friday afternoon, a market that still remains mixed on the back of a month where it's decidedly down here. A yield story, a dollar story, a macro story as well. This is Bloomberg. This is the countdown to the close. About 30 minutes left to go here in the trading day as we close out a month and a quarter, Katie, that I think a lot of people would like to forget.
Yeah, it hasn't been too pretty. Today is no exception, and that's the case, too. If you take a look on the sector level as well, you definitely have more red than green. Up at the top, though, you have consumer discretionary fighting for it, up about 0.6%. Big tech, too, up about 0.5%. But you go down the list, there's definitely more losses than gains. At the bottom, I thought this was interesting. Energy off by 1.9%. Of course, Romaine, that's been the winner all week. Obviously, a different story on this Friday.
Yeah, at least for today. In fact, the oil field services companies really taking it on the chin today. There was no real news out there, but remember, some of the fluctuations that we're seeing not only in energy prices, but of course some of the forecasts out there, that seems to be driving some of the price action. Schlumberger kind of representative of that, down about 4% here on the day. Meanwhile, Carnival pulling back as well, down about 5%. It came out with earnings. They were actually relatively good, but the forecasts they gave going forward show that they're dealing with a lot of issues when it comes to fuel costs, as well as the cost of currency conversions here as the dollar strengthens, not necessarily in their favor. Two interesting stories in the healthcare space. Walgreens Boots Alliance up about 6%. Bloomberg reporting that they're considering hiring Cigna's Tim Wentworth to take over as CEO for Roz Brewer, who of course is departing. And this is a big deal because remember, he is a healthcare person for a company that is trying to transition itself away from being just a retailer and more of a healthcare company. Investors seem to like what they hear with regards to the rumors, and we should point out right now these are still just rumors. Also, Structured Therapeutics having a good day. They were up much more than that a little bit earlier, but still up 33%. They make a weight loss drug, and of course we know all these weight loss drugs like Wegovy are doing well right now, but theirs is an oral drug, so again, no shots here. That has the potential, of course, to be a game changer should they actually be able to bring it to market. Keep in mind that's still in development. I do want to talk about here what we saw during the quarter, both here in the U.S. as well as abroad. Remember, the carry trade was a big trade going forward earlier this year, but that big upturn that we've seen in the dollar, the big upturn that we've seen in yields has really started to upend that trade. It really started to come apart late spring and early summer, but it really accelerated to the downside as we got into this fall right now. Right now, if you were playing that trade, basically going long a foreign currency and short the U.S. dollar, the only ones that you're really making money on right now are the pesos, Argentine peso, the Colombian peso, and the Mexican peso. Everything else is pretty much down, with the worst performers over there in Asia.
Well, let's go from the currency world back to the political world, because the U.S. House of Representatives failed to pass a short-term spending bill and avoid a government shutdown, with hardline Republicans rejecting compromises from Speaker Kevin McCarthy. House Republicans will meet at 4 p.m. today to continue those negotiations. And Bloomberg's Kaylee Lines joins us now from Capitol Hill. And Kaylee, are we expecting anything to happen between now and midnight on Saturday that would avert this shutdown?
Well, Katie, lawmakers are going to keep working. As you said, they're going to be meeting just about half an hour from now this afternoon to try to figure out the path forward from here, given 21 Republicans did join with Democrats to shoot down this continuing resolution that would have kept the government open till October 31st. Many of these hardliners suggested to me when I was catching up with them, as well as other reporters outside of the Capitol earlier, that maybe a shorter continuing resolution could be on the table in order to get more of these appropriation bills passed. Remember, the House has passed 4 of them already. They have 8 more to go. It's a lot of work. It's not going to get done by midnight on Saturday, and still that may be something they are looking at, a shorter term continuing resolution. Either way, it's going to be very difficult for Speaker McCarthy. This vote proved today that there are members of his party that at this point he is just not able to wrangle. And of course, whatever the House can put together, it's still going to have to go through the Senate, and the Senate is working on its own continuing resolution right now. There's a bit of difficulty there as well. Potentially some border measures being added, questions around Ukraine funding, opposition from some senators to Ukraine funding could mean that it also drags a vote on the continuing resolution ultimately down past the deadline. It's just a very difficult equation on both sides of the aisle, on both chambers of Congress, to try to work against this clock here. Time isn't out yet, but we're still waiting to see what picture emerges as to how exactly they can move forward in time.
All right, not that much longer to go here. Kaylee Lines continuing doing some great work there down on the steps of the Capitol as we hope and wait potentially for a potential deal. But as we move forward into the weekend, a deal does not look likely, and the markets are going to have to adjust should they wake up Monday morning with the government shut down. Jeremy Siegal is the Wharton School of the University of Pennsylvania Professor Emeritus of Finance. He joins us right now to talk a little bit more, I guess, about what we've been seeing in the markets. And I do want to start off with the government shutdown and the potential economic ramifications and I guess potential market ramifications. I know it's still early, particularly because we haven't actually reached the deadline, but is this something markets should start to pay more attention to?
Well, the rule of thumb is that every week the government shuts down, shaves a 0.5 percentage point off of GDP. And wow, I mean, that would wipe out all GDP from the fourth quarter if that actually happens. So clearly that's something that we have to pay attention to. I mean, we had a record government shutdown, under the Trump administration, just a little more than 1 month. And that was mitigated because they actually allowed payments to military, which I don't think have yet been authorized. So it looks, if it's a full shutdown, there's going to be economic impact.
Yeah, and we should just point out for our viewers, we are learning that some members of Congress now appear to be trying to advance a bill that would at least address the military agencies and some of the more critical law enforcement and defense agencies, so that doesn't happen. But let's say we do get there, Professor. There's this idea right now that the last few government shutdowns we had occurred in a much different economic environment. We're dealing with high interest rates. We're dealing with maybe a potential economic inflection that could be to the downside here, and I'm wondering how much that could complicate things.
Oh, it definitely complicates things. I mean, look, we have the UAW strike. We have the highest interest rates in decades. And still monetary stringency. Look at this is a critical time for the Federal Reserve. Are they going to get economic statistics? There's another FOMC meeting on November 1st, and there's a question of how much data will they have to act. So. Yeah, there's a lot of uncertainty, and we can only hope that some sort of resolution comes to clear this up with all those other uncertainties that are facing the market.
And it was interesting, Professor. We heard from Minneapolis Fed President Neil Kashkari earlier in the week saying that if there is a prolonged shutdown, it could actually do some of the Fed's work for the Fed in terms of, you think about the economic hit, what that means for inflation. What are your views on that, though? Could this actually make the Fed's job easier in some ways, even if they are flying blind, rather, from a data perspective?
Well, I think it's a sad thing to say. Let's hurt the government to slow down the economy, because really, this idea that it's just a matter of the economy moving too fast that is causing inflation, only has very tenuous support. I mean, the inflationary pressures, first of all, oil, as you know, going up a lot is really due to a supply shock rather than any sort of increase in demand. And we want a strong economy that produces goods. That's not necessarily inflationary. So I hope we don't use that as the need for a slowdown in economic activity.
Well, to your point on oil, I find that really interesting, again, that this is a supply shock driving oil prices. The Fed can't control that. And of course, they pay attention to core figures, which strip out energy prices. But then you think about the read through into inflation expectations, which the Fed does care about. How are you thinking about that dynamic?
Well, and clearly you're right. And, the bondholder doesn't care about core. He cares about overall inflation because that's what erodes his or her purchasing power. So, we can't just say that core inflation is the only thing that's affecting, with the bond yield. It's overall inflation. I mean, we got mortgage rates that are north, I think, of 7.5%. We've had a slowdown in the home buying index. We had a slowdown in housing starts last month. Now, it's not as bad as it was, 6 months ago. But, if we have another housing slowdown in the midst of a government slowdown, it seems very, very hard to talk about positive economic activity in the fourth quarter.
Professor, we got to leave it there. Really appreciate your time on this Friday, though. Our thanks to Jeremy Siegal, University of Pennsylvania Professor Emeritus of Finance. Now, coming up on the close, Nike giving a boost to retail stocks after a strong first quarter report. It's our Stock of the Hour up next. This is Bloomberg.
All right, it's time now for our stock of the hour. Taking a look at shares of Nike having their best day all year long after their fiscal first quarter results pleased a lot of investors. John Edwards joining us right now, who helps to lead our consumer coverage to talk about exactly why. John, is this about revenue growth? Is it about profitability or something else?
Actually, the main focus here is the improvement in their inventory situation. There have been real concerns with Nike and a lot of other retailers about bloated inventories. And in this most recent quarter, Nike had some success in actually bringing their inventory down, which was the first time in a long time there'd been an actual decline. And so that really gave people some hope, some optimism that they're getting that inventory situation under control, and that's going to allow them to clear out some of their old products, move in some higher margin, more expensive stuff to sell later. Yeah.
So inventory better than expected. China, revenue actually disappointed, but I love this quote from the CEO. Sport is back in China. You can just feel it, John. And I guess that optimism is showing in the shares.
Exactly. I mean, it's, a lot about China is about feelings these days, perhaps more than the numbers, at least this quarter. But it's, as some of the analysts said, the quarter was a little soft in some areas, some metrics. But again, that inventory thing was such a big overhang for them that it's kind of overshadowing some of the.
I'm sorry, can we stop? You said sport is back in. I thought you just made this up. I didn't realize this was an exact quote from the CEO.
Yeah.
I wouldn't.
Is that from him or is that like an AI generated comment?
No, he said it on the call, apparently. They have great confidence about the future.
Yeah. All right, well, is there anything we can extrapolate from Nike's results into the broader retail space, or is this very specific to them?
Well, I think, we kind of have to wait and see. I mean, there have been these inventory problems with a lot of their rivals, and Under Armour, for example, had a difficult quarter on that score last time.
Yeah.
All those shares are rising, so there is some optimism that this is going to, translate.
Yeah, that's why I was asking, because I saw Under Armour's up on ON, however you pronounce that. They were up. Even like Dick's Sporting Goods, of course, as a third-party seller.
Yeah, so some of that is just a bit of a halo effect, but we'll definitely be watching to see if at Under Armour they're in turnaround mode. So we'll see if that takes hold.
John Edwards there with a closer look at Nike, our stock of the hour, as we count you down to the close. Kristina Hooper on deck, Invesco Chief Global Market Strategist. Stick around. This is Bloomberg. This is the countdown to the close. Romaine Bostick here alongside Katie Greifeld, who's very good, almost great. And great. We talk about a market that really isn't very good. At least it wasn't in the month of September here. And it looks like it's going to end the day on kind of a mixed note here. This has been the oscillation really that we've been talking about for the last few days.
Yeah, not so great quarter after what had been a very good year. Obviously, the wheels kind of came off that AI narrative, that big tech trade over the past 3 months. And today, not so different.
Yeah, I mean, we take a look here at kind of what's moving, at least on a daily basis. I mean, you do see the Magnificent Seven higher on the day, but we didn't get a lot of juice from them over the last few weeks or months, and a big part of the reason why you're seeing the broader market down on a basic monthly and a quarterly basis. And then the downdraft that we've been seeing today in the energy space has been quite interesting to see a lot of those like Marathon Oil, Halliburton, all moving lower here on the day.
Because that's the trade that's worked this past quarter. That's been your haven of sorts.
Yeah, absolutely. Here, let's get some insights out of our next guest here. Kristina Hooper joining us right now. She's the Chief Global Market Strategist over at Invesco, joining us to help count down to the close here. And let's kind of look at the big picture here, Kristina. I mean, coming off of a quarter where we gave back some of the gains that we had from the first half of the year, but we should still point out on a year-to-date basis, most of the gains in this market are still tracking above historical averages.
Absolutely. I think we have to recognize that the third quarter of the year has been something of a stumbling block because Treasury yields went up significantly. I mean, if we look at the 30-year yield, it was up around 80 basis points this quarter. So there was a lot of pressure on stocks. But having said that, this was still a relatively good environment if we look at the entire year.
And there's been a lot of people that are sort of concerned about, I guess, the negative catalysts out there, Kristina. But I just want to look at the glass half full for a second, because we got another inflation report this morning with the PCE data, which seems to reaffirm that there is still a pretty persistent disinflationary trend right now that I think would be welcome news, not only to the Fed, but to the market as well.
Oh, absolutely. What we are seeing is very much a disinflationary narrative in place. It's taking hold. In fact, I would argue that it's accelerating a bit. And it's not just the U.S. We're seeing it in Western developed economies. We got a good Eurozone inflation print as well today. This is what happens when central banks get aggressive in terms of tamping down inflation. So we're seeing that impact. And ultimately, I think that will translate into good news for the stock market. One of the biggest problems as we ended this quarter was that dot plot last week. And I think that caused problems and certainly jacked up yields on the long end.
Well, let's talk about that, but let's first go back to the point you made that this disinflationary impact, this narrative, it's continuing to gain momentum globally too. And then marry that with what we're seeing in energy prices, because the conversation we've been having for weeks now is how that impacts and filters into consumer inflation expectations. But even with this months-long rally that we're seeing in oil in particular, it feels like that hasn't yet translated through.
Well, it typically takes time for higher energy prices to seep into core inflation. And so the impact we tend to see more immediately is on consumer spending, which could help the Fed, and also in shorter term consumer inflation expectations. But we just got a University of Michigan survey today that showed that actually 1 year ahead consumer inflation expectations are down from August. August, they were 3.5%. They were 3.2% for September. So that suggests that the consumer really isn't assuming that this is going to last for long and is going to impact even 1 year ahead inflation.
And we'll see, of course, how that evolves, especially with what happens in the oil market, which has been one of the more interesting asset classes to watch. But back to your point on the dot plot, it feels like that caused a lot of indigestion in the market. And I guess my simple question to you is, why? Because Powell himself was very clear that the dot plot, it isn't necessarily a plan set in stone.
But it is the most tangible thing markets have, right? So it used to be that markets really seized upon the size of Alan Greenspan's briefcase. For rightly or wrongly, that's what they did. And so now you actually have a dot plot laid out with each FOMC member's expectations. And so it just seems natural to seize upon it, even though we know it is incredibly imprecise, especially the further out we go. And my reminder, of course, is the December 21 dot plot, which suggested that the Fed funds rate would be at 90 basis points by the end of 2022. And we know what happened there, well above 400 basis points.
Yeah, I think a lot of people are starting to take some of this with a grain of salt here. I want to get your thoughts, though, Kristina, on the upcoming earnings season here and whether that provides any sort of a salve for the market.
Well, that's a great question. Thus far, markets have prepared for the worst in terms of earnings, and so they've been pleasantly surprised, even though one could argue earnings have been relatively lackluster. They've just been managed well, and expectations were low. So we could see a continuation of that so that it wouldn't be any kind of significant downward pressure on stocks. But I don't think that upcoming earnings season is going to be anything that really provides a significant tailwind for stocks. That tailwind is likely to come from longer-term yields coming down.
That's interesting. So this still remains a very much macro-driven market in that sense.
Oh, absolutely. I think that central banks are driving much of what's happening in markets and will be for some time until we get clarity that the rate hike cycle for the Fed has ended and we get more comfort that we're likely to see more rate cuts next year.
Kristina, always great to talk to you. Kristina Hooper there over at Invesco, helping us count you down to the close here on the final trading day here of the month, the week, and of course the quarter as well here. And I think a month, a week, and a quarter that I think a lot of people would like to forget. We're basically down 4 to 5% in the month of September for most of the major indices here in the U.S.
And it's interesting to hear Kristina say that, again, this is going to be a macro-driven market. It's going to be much more of the same, even as we head into that earnings season, even as we get some of those new narratives from the companies. Still, it's all about the bond market.
And that's going to be disappointing to some people, because I think a lot of folks really thought the Fed was kind of behind us, right? Obviously, you always have to pay attention, but the idea that they would be such a big player in this market still, given their commentary, given that dot plot, if you believe what's on it there. And this is what markets are going to have to contend with, at least for the next few months.
At least for the next few months, and we'll see. I mean, of course, we have plenty of wild cards from the strikes to the shutdown, et cetera, et cetera. All wild cards that seem to be big risks at this moment.
Absolutely. Not a whole lot moving higher here on the day, a smattering of consumer discretionary stocks. And I think you brought it up a little bit earlier, Katie Greifeld, really the only trade that made money on a sector or group basis over the past month and really the quarter was actually energy stocks.
And that's interesting because at least for the last 2 years, energy has been the top sector in terms of performance. As much time as we spend talking about tech, it's been energy. We'll see if that's the case this year as well.
We are moving closer to these closing bells. Our full market coverage right here on Bloomberg. It starts in a second as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Katie Greifeld. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with our friends Carol Massar, Simone Foxman filling in today for Tim Stenovic, and welcome to all of our audiences across all of our Bloomberg platforms here on a Friday afternoon where we take a look back at the month and the quarter. Carol Massar, and if you bought stocks, you're in the red. If you bought bonds, you're in the red as well.
Yeah, it's been a tough quarter, no doubt about it. And I feel like there's still a lot of uncertainties about kind of what comes next in the fourth quarter. Having said that, Michael Sheldon over at Hightower RDM Financial was on with us, and he said one of the things that we kind of maybe can count on is that we are definitely near the end of this rate hiking cycle. So what does that mean? If perhaps maybe we get no more hikes. Typically, on average, the Fed starts actually cutting rates 8 months later. So if perchance September was the last hike, you could see maybe a cut come May 2024.
You could also potentially see some kind of optimism in the stock market even a little bit sooner. Our Terrell Holt, he worked out the numbers here. He said, don't bet against the rally in Q4, at least if you look back at the results since 1950, when the S&P 500 was up between 10 and 12% year to date by the end of September. Q4 was higher 84% of the time. We're looking at an S&P 500 that's currently up 11.7% despite all these losses this month, guys.
It'll be interesting if we see that reset, because there's been a lot of talk about how valuations have come down, those multiples, if you will, here, but they still are sort of camped out above those historical averages. And of course, right now, a lot of the key technical indicators are in play as well here. Let's walk through the numbers here. We have a lot to parse here. The Dow Jones Industrial Average down on the day here by roughly about 0.5% as we wait for these numbers to settle. That's going to give it a loss on the month of about 3.5% and a loss on the quarter of about 2.6%. The S&P 500 down 11 points on the day, or 0.3%, nursing a 5% loss on the month and 4% for the quarter. The Nasdaq Composite actually holding into the green here on this Friday afternoon, only about 0.1% here, but that's not good enough to erase some of the losses that it had earlier. 6% down on the month for September, 4% for the quarter, and the Russell 2000 also going to close out on a down note, 0.5% on the day, Carol, and 6% on both the month and the quarter.
All right, a great check, right, on the month, on the quarter, in terms of where we're ending up. I am pulling up the S&P 500 and taking a look at the individual names for the third quarter, and it is at the top of the list, largely, Katie, those energy names. Marathon Petroleum up almost, actually about 30% in the third quarter, but there's a lot of energy names. At the top of the pack, you're looking at names like Dollar General, Insulet Corporation, and Solar Edge. They are some of your laggards for the third quarter.
Well, to your point on energy, it had a great quarter, but it had a terrible Friday today. Energy, that industry group, off by nearly 2%. Of course, that has been the outperformer of the week, of the past 3 months. Not so hot today. You look at what is doing well, though. You have consumer durables, you have autos, you have some of those semiconductor names. So you do have some green, but overall still very much a down day, Carol.
All right, down day. So let's get to, did I find some gainers? I actually did.
Oof,
Nike.
Got it today.
Wait. We'll see. Nike up 6.7% here at the close, up about 11% at its highs of the day. Top in the S&P 500. earnings. We broke them down after the close last night, jumping the stock after surprise quarterly results indicated that demand for Nike's goods is actually strong and growing despite a challenging consumer environment. Everybody was worried. Revenue, though, I should point out, for their latest reporting season was shy of estimates, but nonetheless, definitely a rally in today's session. And check it out, everybody. Walgreens Boots, top in the S&P 500 and the NASDAQ 100 on this Friday. That stock ending with about a 6.4% gain. Company apparently considering a former Cigna executive, Tim Wentworth, to be its next CEO. This, according to folks familiar. What's interesting is this is someone who has been in the healthcare space in a big way. Express Scripts. He really brought about that merger with Cigna. So it's a company that we know going through some changes, if you will.
But this is it. I mean, they've been trying
to
pivot to healthcare.
Yeah.
And I mean, Roz Brewer, I mean, she's obviously a great executive, but she had a retail background. And, you know, at a time when they were trying to sort of be less of a retailer and more of a healthcare space.
Right, exactly. Well, maybe this guy with his experience, maybe he brings something different that she didn't, but the stock didn't do well under her. We know that. So investors may be hopeful. Fingers crossed, we will see. But anyway, so some speculation there. And then this is, I wanted to bring to you a $1.9 billion market cap biotech IPO'd earlier this year. Structure Therapeutics surging in today's session. We'll bring it up for everybody. Up almost 35%, hitting a record high. The company reported top-line results from an early-stage study of an investigational oral weight loss drug. This is a year that's all about these weight loss drugs. Anyway, maybe closing the gap with some larger competitors, but investors pretty enthusiastic about it. I feel like it's AI. It's about AI. It's about weight loss drugs, a few other things this year.
Has it all.
Yeah, well, maybe.
Well, one of the things that has been such a good performer so far this year has been some of these tourism names, but definitely a down day for several big tourism stocks. Start off with Carnival, which reported earnings profit for the first time for the first quarter since 2020, and record revenues in the third quarter, but saying that higher fuel costs, higher currency costs are going to have a big hit, revised down its fourth quarter outlook, and could hit the full year outlook by as much as $130 million. However, they did say no signs of consumer demand slowing down, but the markets didn't love that. Shares closing down just about 5%. Also seeing some losses in Vail Resorts, falling 8.4% today. Seeing better than expected purchases of season passes. Again, that demand story decently strong. However, Truist calling their financial outlook for the current period very light, a very mixed outlook overall. Finally, I want to call your attention to Baker Hughes. Their shares down 3.47%. And this after it talked about the U.S. oil rig count down by 5 to 502. And this is really interesting as we look ahead to OPEC next week, in part because, production, U.S. crude production reaching its second highest level on record in July. But oil field services companies may not really be convinced that this strength in the price of oil is going to continue because they're kind of cutting their oil rig production. So really interesting, a bit confusing, I think, story there. But again, looking ahead to OPEC next week.
Of course, let's take a look at yields because, of course, that was the big story in the month. Once again, benchmark 10-year yields about 46 basis points higher today than where they were at the start of the month here. You see the changes here on a daily basis here, relatively modest, but the uptick that we saw, the rate of change that we saw over the past 3.5 to 4 weeks here, I think really rattled markets. And when you start to get commentary out of, the Jamie Dimons and the Larry Finks of the world, basically saying that we are going to see rates even higher than where they are now, that causes a lot of concern. And I want to bring up the fact, guys, that we heard from John Williams over the New York Fed. And he also made it clear he doesn't think the Fed necessarily needs to raise rates, but he also made it clear that a cut isn't in the cards anytime soon. He plans to keep them there here. And I think that was a big part of the reason why you saw a bit of a reversal in the market today here in the afternoon.
Yeah, it's been interesting to see that reversal. And you add it all together, it was a pretty quiet day in the bond market. But it's also been interesting to watch how this has played into the shape of the yield curve. I want to talk about the 2s10s curve a little bit. It's still minus 47 basis points inverted, but I remember when we were in double digits over the summer, so we've really taken back a lot of ground when it comes to that inversion.
I think the tricky part now is to figure out what higher for longer means. What is that for longer? And this is what I think when it comes to any kind of asset class that's out there is like, what is the value in what higher for longer environment means. So I guess that's the tricky part, and I'm curious to see whether
Are you not taking it literally?
Well, what does higher for longer mean? It's
and can we get used to it over time? Can we get used to 30-year fixed mortgage rates of 7.3%? I mean, that seems crazy given where we were.
No.
No.
If you look at the housing market right now and there's just a lack of deals being done, I think the answer to your question, Simone, is no. I mean, maybe, like I said, if this stays longer for a certain period of time, I guess there are people that are going to have no choice but who need to buy a house or are going to have no choice but to pay it. But yeah, if you don't need to, why would you?
I think the housing market, I mean, Romaine, it's a great point that you can't always pick when you're going to move. You have life changes, you need to move at some point, but I think there's going to be a lot of pent-up demand. Once we actually do see a drop in rates, imagine all the people who have
Do you know anyone specifically?
I know a few people. If I look inward,
somebody just buying a house. I know another couple looking at it, and some of it has to do with needs. They're growing their family.
Yeah.
They need to do it. So it's
if you need
interesting.
to, right?
Yeah. But I'm saying for people who maybe live in a city and they plan to be there for a while, they would like to buy an apartment, but they do the monthly math.
Is this you or somebody else that we know?
Completely hypothetical person
Completely
with black
hypothetical.
Hair.
Maybe there's a lot of people timing the market right now.
Did you guys see the B of A data of investors trimming cash and bonds to buy U.S. equities?
Yeah, I saw that.
What did you think about that?
Well, the problem is I feel like
impressed.
this data is conflicting because then you look at the data we got yesterday on money market funds hitting another record. So I don't know. There's certainly a rotation going on, but it's not kind of that big wholesale rotation that I think people want to see.
I just want to know who's going to the Jet game this weekend.
Taylor Swift?
Yeah. Who's going?
Yeah.
What if she's not there?
So
and you pay all that money for a ticket? Aren't you going, Carol? You live right next to the Meadowlands.
Yeah, I live right next to it. It's
Yeah.
like, out my back door. No, I'm not going. I'm a Giant fan, by the way.
Okay.
Oh.
Well, yeah, I mean, it's good. Okay. I
know.
mean,
We gotta
condolences, first of all. But yeah, I mean, it's good that.
That's so true.
It's good that we have New Jersey teams to root for.
It's good that we have New Jersey in the union. I'm just going to say. All right. Yeah. Hey, Katie, are you agreeing?
I agree.
All right. Where's that horse go home?
I don't know.
All right.
Maybe he's
Somewhere in Weehawken, I'm told.
He's not in Manhattan, I'll tell you that.
Thank God, right?
Ho-ho-cus.
All right. Get home.
Ho-ho-cus.
Get home safely. Have a good weekend, everybody. Teller or
too.
no teller. And we will see you again to kick off the fourth quarter. Our cross-platform coverage, radio, TV, YouTube, and of course, Bloomberg Originals Beyond the Bell. We'll see you on Monday.
We continue our coverage here on The Close, right here on Bloomberg Television. A lot to unpack for the week that was, the month that is now past, and a quarter that has been. Another month of trading has come to an end. We're going to take you through those highs and lows. This is Bloomberg. As we wrap up the month of September, the chart behind me really tells the story. On the far end of the screen there, stocks lower on the month, commodities lower on the month, bonds lower on the month on a price and total return basis. The only real asset class that had any sort of meaningful performance, that was the dollar. And well, unfortunately, that's not necessarily good for assets going forward here. That is the setup as we close out the month of September, a month that is seasonally supposed to be one of the weakest of the years. And of course, that feeds into October, a month that is seasonally supposed to be one of the best of the years. When we take a look at some of the individual performers here over the last month and the last quarter, I wanted to give you a sense of some of the winners and losers and whether those names actually remain that as we move forward. Now, you're looking at the price action on a daily basis, so this is what happened today. But Valero, one of the best performers in the month of September, one of the best performers, in fact, for the quarter as well. Centene also near the top of the screen when you filter through the S&P 500. And to the bottom, it's Dollar General and FMC. The idea that the two of the best performers in the month were in the red on the day and two of the worst performers in the green, is that a signal of a flip-flop or maybe something just idiosyncratic here for this particular day and time? What isn't idiosyncratic are some of the moves that we've been seeing in the Treasury space here. The 10-year yield, the benchmark out there, as it sits today, about 46 basis points higher than where it sat at the end of August. That is the big story here, particularly when you have a Larry Fink saying that 5-6% could be in the cards, when you have Jamie Dimon saying that 7% could even be in the cards, and when you have Fed members like John Williams basically making it clear that higher for longer is the new mantra of the Fed etched on the side of that building. Katie?
And clearly that's been bad news for the bond market, for the equity market. But the good news is that it's time for Factor Friday. And Chris Kane, he is equity strategist for Bloomberg Intelligence. He joins us now to walk through some of the action. And let's start with the value factor, because when we talk value, we're usually talking about some of those large names. But how has value worked when it comes to some of the smaller companies?
Yeah, Katie. I mean, we always talk about value really applied to the S&P 500 or Russell 1000, aka large cap stocks. When you look at the value factor within small caps, though, they've done actually a whole lot better than large caps. Looking at a long short factor using price to book in small caps using a Russell 2000, it's up about 8%. What's interesting is the price to book value factor is actually one of the worst performers of all the value factors. We prefer using price to sales for small caps because a lot of the small caps don't have EBITDA or earnings, so it's kind of tough to use a price to earnings measure. But a price to sales long short value factor in small caps is up 14%, up over 20% if you don't neutralize by sector. Taking a step back, we have cheap stocks beating expensive stocks in small caps by over 100% starting in 2021. So it's certainly been a good run for value in small caps, and it does continue this year.
Well, you used the word cheap here, and I know that you've been on this program before, and you talk about some of the relative cheapness that you see in value in the large cap space. Does that apply to small caps as well?
Really interesting, Romaine. It's actually completely different. We speak about the value factor in large caps being cheap. And what we mean by that, just to be clear, is not on an absolute basis. We're talking about cheap stocks versus expensive stocks. How much cheaper are they? When you look at that in small caps, it's actually not much cheaper. So, cheap stocks are roughly 27%. The valuation of expensive stocks, when you break them up into quintiles, that's actually a lot higher than history. They've actually averaged about 16% the valuation of the expensive stocks through history. It's a 90th percentile reading. So, unlike their large cap counterparts where the value factor is very cheap, I certainly wouldn't say it's super cheap in small caps, but that would make sense considering it's performed so much better.
And Chris, before we let you go, moving past valuations, what else stands out fundamentally when you take a look at the value factor applied to small caps?
Yeah, so we were looking at the value factor, and like I just said, it's not that cheap. So we're thinking, why is it not that cheap? Why is it unlike large caps? We dug into a little deeper. We looked at the median profitability, the median return on equity for these cheap companies is actually higher than the median return on equity for expensive companies. And that's very rare. You would think that the cheap companies have a lower profitability because that might be why they're priced so cheaply. But right now it's over 2.25 percentage points higher as far as a median ROE basis. It averages, like I said, over 1 percentage point lower. It's actually in the 92nd percentile reading over the last 25 years when you compare the profitability of cheap versus expensive in small caps. So to me, that elevated profitability really does justify the not so cheap valuations of the factor.
Chris Kane here on our Factor Friday over at Bloomberg Intelligence. A nice look here at some of the factors that drove the market over the past week. We want to take a broader look at what happened in the month and bring in Emily Greifeld into this conversation. Bloomberg cross-asset reporter here. We've seen the price action in the equity market. We know it was a down month here, but was there any pockets out there where anyone actually did make money?
Well, if you look at some niche commodities markets, there have been some opportunities to be made. There was a hedge fund called Mulvaney Capital Management. It's based out of London, and they are a fully systematic, quant-based trading strategy. And they made some bets in smaller commodities markets, think cocoa, sugar, livestock, and we don't have the returns
all my favorite
for
foods
this month. Exactly, but they're up 60% through August. We don't know exactly how they were positioned, but we do know that a lot of these commodities, cocoa hit a 12-year high this month, sugar also hitting a near decade high this month. So we saw some pretty big extreme trends in these markets, which likely led to gains for Mulvaney Capital.
Of course, another big story, of course, was what we saw in the fixed income space, particularly with short-dated fixed income, probably the shortest of short-dated here. A lot of people still moving into cash.
Yeah, we saw a resurgence of people heading into cash, just like they were back in February and March. This was the 4th straight month of positive inflows for cash-like ETFs, about $4 billion. And then Katie Greifeld and I also wrote about our very own Katie. We wrote about investors piling into floating rate ETFs to perhaps capture a bet that maybe rates are going to go higher for longer and you want that floating exposure on your income payments. So people really dashing for safety in the month of September.
We got to submit that for a Loeb Award next year.
I know. Apparently, it was a goose egg last night. But Romaine, just to take you into the sausage making process of that
I like
story.
sausage too.
We were talking about the floating rate story at the end of last week, and we were saying, okay, maybe we write a story about how the best days are behind that trade. And then the narrative changed again this week. It seems like floating rate is still very hot right now.
Yeah, exactly. And I think like this whole month, we saw Treasury yields climbing, but it seems like equity investors now post-Fed are finally starting to digest that message that the dot plot changed. The Fed really said we're not planning on cutting anytime soon. I think it took a few days for that message to really permeate through. But now you look at the equity positioning, you see traders piling into cash, and you also see on the hedge fund side, hedge funds are very short stocks right
I want
now.
to talk more about positioning because, of course, I think September in particular and August too caught a lot of people by surprise. How is that playing out when it comes to what we're seeing in terms of how people are positioned in equities, for example?
Well, so when you look at hedge funds, they're ramping up their bets against stocks, driving net leverage, this is according to Bloomberg, to the lowest levels since the depths of the pandemic. But this is another story that our wonderful Katie wrote
Wow.
earlier this year. You know, I prepared. I knew we were going to talk.
Is this a setup? What's happening here?
I slipped her a 20.
Exactly. But the yield, the earnings yield that you can get on stocks is lower than what you can get on Treasury bills. So I think that's also why people are so heavily invested in cash right now. Why would you buy a stock if you could scoop up that yield, you know, above 5%? In stock.
I've literally been asking that question all year. Romaine's heard me ask it many, many times. I haven't gotten a good answer yet.
Yeah, she just like pings me at like 2 in the morning and says, you know, I was just thinking about why more investors aren't doing it. Emily, great to catch up with you.
Thank you.
Emily Greifeld, that concludes our Katie Greifeld wrote this segment. Coming up here, we're going to talk about the weather. We're going to give Katie another chance to vent because when it rains, it pours. And New York City, in all seriousness, has really gotten deluged today here. You're seeing some of the flooding there in parts of New York. It's shut down the transit system here and having an outsized effect here on a lot of communities. We're going to talk about the impact, the state of emergency right now in the state. This is Bloomberg.
Well, torrential downpour in the New York City area today. Streets flooded, commuters drenched, and subway lines and highways shut down. And of course, multiple flights canceled. Both New York Governor Kathy Hochul and Mayor Eric Adams declared a state of emergency.
All the necessary precautions were taken. We have gone through these flood-related and heavy rain conditions before. The city still has to operate with minimum disruption.
Joining us now with more on this wild weather is Bloomberg's Skylar Woodhouse. And Skylar, give us an update on where some of these transit services stand. For those of us, such as Romaine and myself, who have to commute home, what does it look like right now?
It's still not the best situation. It's still very wet outside. The rain is still coming down. City and state officials are expecting even more rainfall to come. So it's going to be a tricky rush hour for everyone trying to get home. Train lines, the subway lines are still suspended. And even if you're going, farther out of New York City with some of the commuter rails, they're also facing issues. And New Jersey Governor Phil Murphy also declared a state of emergency. So it's going to be a challenging commute home for a lot of people.
I want to talk a little bit, though, about, I guess, kind of why we're seeing these images that we're seeing with the flooding waters. I mean, look, rain happens, but at the same time, you have to have a sewer system that can handle the rain. And I just looked this up here on the New York City's Department of Environmental Protection website here. 1.75 inches is basically per hour, is basically what the drainage systems here can handle. We got about 2 inches just in 1 hour alone earlier this morning. And overall, today, we've gotten somewhere in the neighborhood of 6 to 8, depending on who you believe here. Is there anyone sort of talking about these drainage issues, these infrastructure issues, and how they can be corrected so that when we get another deluge like this, we're not all just stranded at home?
Yeah, because we saw this happen a few years ago when Hurricane Ida swept through the metro area, and we saw the flooding, we saw the streets were flooded. So city leaders, state leaders, anyone at any sort of upper level management role in the city state, they're having to have these conversations on how to better prepare the infrastructure for when moments like this happen. I mean, and if you've been in New York the past couple of weeks, we've been getting constant rainfall. It's just been coming down. So these sewers are just now backclogged, and it's like they can't handle the rain anymore. And so now they're spilling over to the streets and to the subways. So people are going to have to figure out, okay, how are we going to be able to navigate this, especially as we're seeing climate change in real time.
And I mean, maybe those conversations took on more urgency in the past couple of weeks, to your point, Skylar, but even still, I mean, what kind of timeline are we talking about when it comes to maybe upgrading, modernizing the sewage systems, the transit systems?
Oh, yeah. I mean, the agencies are starting to have these conversations on how to best move forward. Think of the MTA, for example, with congestion pricing coming or at some point coming down the road, they're hoping that the money from congestion pricing can help fund a lot of the capital improvements that the system needs. And, with those improvements can come upgrades so that way these, when events like this happen, these systems can hopefully be a little bit better prepared. So that way people aren't getting stuck in the trains, like down below, or even just in the streets, to better help with the sewer problem. So that way there's maybe some more room for where the water can go.
Yeah, Skylar, great to talk to you here. Stay inside, stay safe. Another interesting factoid, Katie Greifeld, that I actually learned from this website here is that 60% of our drainage system actually combines storm runoff with sewage in the exact same pipes.
Ew.
There you go. All right, coming up here after the break, we're going to get some insights on what's been going on in the markets. Byles Williams is going to be joining us. She's the Chief Executive Officer and the CIO and founder over at Xponance. That conversation coming up after the break. This is Bloomberg. The price action in U.S. markets on this Friday was, quite frankly, a kind of fitting end to the month of September and the quarter as well here. A choppy price action once again here, where we saw the NASDAQ poking to the green towards the close of trading, up about 0.1%. But the Dow and the S&P in the red. So too is the Russell. And on a monthly basis as well as a quarterly basis, all of the major U.S. indices finishing out in the red, roughly 4 to 6%, depending on which one you're looking at. If you were buying in the bond market, at least on a total return basis, you didn't make any money there as well. If you bought in commodities on an aggregate basis, you didn't make any money there as well. The only saving grace was really in the energy space. That was the outperformer, both in terms of the actual physical commodities themselves, i.e. crude oil, but also the stocks as well. In fact, of the 11 S&P sectors, the energy sector was the only one to really post a meaningful gain in the month and in the quarter. And quite frankly, when you talk about what the setup is going into the next month and the next quarter, it might actually still, Katie, be the same stocks.
Well, we'll see how the fourth quarter shakes out, because high inflation isn't going away anytime soon, at least if you ask BlackRock CEO Larry Fink. He spoke with Bloomberg's Danny Berger from the Berlin Global Dialogue Forum earlier today.
Look, we all have opinions. I mean, I've been saying for over a year.
I want to know your opinion, Larry.
My opinion is we're going to have 10-year rates at least at 5% or higher. Because of this embedded inflation. This structural inflation is unlike anything. And I think business leaders and politicians are not providing the foundation to help explain this. We have not seen inflation like this in over 30 years. Actually, I was a young bond trader during the late 70s and where we had hyperinflation. I don't think we're going to have anything close to the inflation of the 70s, but we have so much deeper structural inflation, and we are underestimating the change in geopolitics is so structurally inflationary. When I was in Davos earlier this year, I heard the phrase national security. uttered everywhere. And quite frankly, I never heard those phrases uttered that often before that in all my years. So national security for chips or food or energy, obviously energy, and all these issues. And the question is, at what cost? And nobody answers that question, at what cost?
Well, there are a lot of calls of a recession: hard landing, soft landing, no landing. They've all lost their meaning at this point. Let's be honest. So in this era of fear, of no hope, are we headed for
there's not no hope. It's all, I'm hopeful.
Let's hope. Larry's hopeful. We're happy about that. But does that mean we are headed for a recession right now?
So I think we have to analyze that by each region, because the United States, our home mortgage market is based on a 30-year mortgage. So anybody who has a home mortgage, higher interest rates does not impact them. And so the transmission of high elevated interest rates in the U.S. takes much longer to impact the economy. Whereas in other places where you have more floating rate, or like in the United Kingdom, where you have generally a 5-year fixed and then it resets. And so let's assume 20% of the mortgages have to be, reevaluated at a higher level. That creates more immediacy at higher rates. So I think we're going to see some economies enter recessions early.
Which ones would that be?
Well, I think Europe.
Is anyone's more sensitive to
the ones that are more sensitive to this elevated interest rates, and you're starting to see a real decline in GDP and other. They're basically flat now, but can they go into a more protracted recession? Whatever the recessions we're going to have, they're going to be quite modest. So I'm not even that fearful. But the other issue.
I have a stat for
let me just say one thing,
yes,
Danny.
Yes, then I'll inject the fear.
But I believe if we have labor shortages, if we're getting back to this whole social issue of how are we going to be doing this, in many areas you may need a recession to bring down labor demand. And so I think this is one of the things that's going to impact in the United States. You still have a very vibrant economy. The United States, and as I said, the J curve of the Infrastructure Act, the CHIPS Act, the IRA, which has huge implications, that's going to be creating jobs. And so it may require a more protracted Federal Reserve, and it may mean by 2025 the United States economy may be entering a recession, but I don't see it any time in the near term.
All right, the head of the world's largest asset manager there, Larry Fink, speaking a little bit earlier there at the forum. Joining us right now here on set is Tina Byles Williams. She's CEO, CIO, and founder of Xponance. It's a $14 billion multi-strat fund. And Tina, I want to get your thoughts here on kind of what we heard from Larry Fink here, and I guess whether the market is going to really be driven by, to a certain extent, what we're seeing in the Treasury space.
Yeah, well, look, at this point, the increase in Treasury yields is presenting a bit of an asynchronous risk-reward payoff, in that I did this when yields were at 4.5%. If they drop to 3%, which is kind of consistent with a recession, you're talking about a 17% return. If they increase to 5.5%, you're talking about a 2.5% loss. So. So I think Larry Fink is right. There is probably more room for Treasury yields to increase, but the risk-reward opportunity for increasing duration is getting quite compelling.
Well, that's what I'm curious about, too, because we talk about the balance that I think kind of existed earlier this year in the markets here. And we seem to be kind of at that inflection point where you can go in any direction here, and that payoff, that risk reward, if you will, probably is not necessarily as favorable as it was a few months ago. Right. Potentially favorable.
Exactly. Yeah. Exactly. But I also agree with the notion that the American economy, there are just a lot more, there's less transmission of inflation or of rates into the economy. You still have a consumer with, over $1 trillion of stimulus money left to spend. And corporate balance sheets, obviously at the edges, you're seeing some stress, but are still, reasonably healthy. And then there's no there's not going to be fiscal retrenchment. If anything, it's neutral. So if you think of all the legs of the economy, I don't see a case for imminent recession.
Tina, it's interesting to hear you say that, because one of the big mysteries over the past couple of years is how resilient the economy has been, how resilient the consumer has been. And listening to you, it sounds like the answer is just that this economy is less rate sensitive than maybe we were expecting.
Yeah, and look, the consumer has been deleveraging for 15 years since the GFC. So even when the stimulus money was kind of given to them, their balance sheets. Now, again, obviously, the pandemic introduced some stress. But relative to, say, the GFC, their balance sheets were in much better shape. And so, which is why I happen to believe that I call it the YOLO consumer, in that, the tolerance for austerity has diminished substantially. If you look at median voter preferences, the consumers will say, I care about the budget deficit, but maybe the sixth choice before that is terrorism, my medical care, all things that increase the deficit.
And things that are more, right,
I was going to say the YOLO consumer, FOMO trading in the stock market. We have a lot of acronyms. I want to go back to the point you were doing about bond math, though, because I'm not very good at math, but I do understand that a 17% gain looks really attractive, especially when you consider the risk of just a 2.5% loss. So if we saw rates actually increase and you saw that loss come through, that 2.5% loss, I would imagine on the 10-year yield, a 4.5% yield, a 5% yield would be some comfort there, even if it went against you.
Yes. I mean, look, I advise long-term investors. So that trade-off is an attractive trade-off, particularly when you look at sort of other options which are equally stressed and certainly don't appear to provide the same trade-off.
So that's the story at the long end of the curve. You have that very asymmetrical risk profile. How are you thinking about cash, though? Because we were just talking about this 20 minutes ago. One of the big questions this year is, why would I go out the curve when I can get 5% and above sitting in Treasury bills?
It's a good question. And I mean, look, for an institutional investor that has a different horizon, there's a different answer to that than an individual investor. I think if, as an individual, I would say, yes, why would you? But for an institutional investor, obviously the prospect of a 2%, even 3% loss over a short term, that trade-off becomes more attractive.
I'm curious, for those investors that are looking for a more meaningful return and are willing to take some degree of risk in order to get that, there's been a lot of discussion about how a lot of big institutional investors and wealthy individual investors have started to seek out more of the private markets, whether it's private equity commitments or private debt, debt commitments as well here. Do you see that as, I guess, a favorable competitor, if you will, to what we're seeing in the public markets?
Well, we're starting to see cracks in different parts. And one of the parts of the market that we're seeing the early signs of cracks, anyway, is in the buyout market, which is, if you sort of broke down private equity in particular, that's by far the largest component. And so, Bain did a study where they looked at value creation, and most of it came from valuation expansion. Actually, I think it was something like 68%.
I believe that, yeah.
5% came from margin expansion. And if you kind of think that through, what drove valuation expansion? Low rates, lots of liquidity, and, and so I think that, first of all, private equity GPs have to focus more on margin expansion in a much more difficult environment. And I think, clients or LPs need to temper their return expectations with respect to private equity in general.
And Tina, if we were having this conversation just a couple of months ago, we probably would have started with artificial intelligence. And I think it's really telling that we're only getting to it now. But when you're having your conversations with those institutional investors that you work with, what do those conversations sound like around AI and the promise of AI?
Promise is a good word. Look, AI will be transformational, right? And, you know, the various estimates that demonstrate that. The question for me is the market's pricing, now obviously that has come off the boil some, is the market's pricing of AI at this point reasonable? And I don't think it is. I looked at the internet stocks, 1995 to 2009. They didn't actually outperform the S&P. 2010 to 2023, they substantially outperformed. What was the difference? The network effect, which molded profits and monetized the business model. So I keep asking people, what's the network effect for AI that is particular to these 7 stocks? I mean, as opposed to distributed.
Yeah. All right, Tina, it's been too long since we last spoke to you. Great conversation. No, you're not going too long. You're fine. Tina Byles Williams there over at Xponance. So stick with us. We'll be back in a moment with Ruchir Sharma. This is Bloomberg. Absolutely. Welcome back to The Close. It's time now for our Wall Street Week daily segment with the host of Wall Street Week, David Weston, who joins us every day. And David, of course, I think, what are we, about 30 or so hours away from a U.S. government shutdown?
Looks like that's where we're headed. And we talked to Ruchir Sharma of Rockefeller International. He'd been talking about how much fiscal stimulus is still in the system, the money we've borrowed to make that work. But then I wanted to ask him, what about those people in Congress who are sort of getting fed up with all the money spending and are going to shut down the government? This is what he said.
This is an actual shutdown. Obviously, sort of it begins to detract from growth. But I think that so far, most people think that the impact will be rather modest and the worst will be averted. But every week that we have the shutdown, it'll obviously have an impact. The issue here is that no one is doing this on any great principled way, which is the fact that, as we have discussed in the past, that if you look at the last 50 years, the US has run a budget deficit practically every year in the last 50 years, no matter if you've had a Republican or a Democrat president or whoever has been in Congress. And that's what's happened, that because for 50 years we have run these deficits, the attitude has come to be of policymakers that deficits don't matter, that you can keep running deficits. There's been no apparent adverse effect of this, so why should we care? And now what's happened is that they've taken deficit spending to a totally different level, which is that in the past, the US would run a budget deficit of, let's say, around 3% of GDP for much of the last 10, 20 years. That was in line with what other developed countries were running. Now the US budget deficit is projected to be 6% of GDP a year for the foreseeable future, twice as high as what the US was running and way higher than what the other countries are currently running. So the question now becomes that this is leading to much higher interest payments. It's leading to a much higher debt load. I think the US now, public debt as a share of its economy is behind only Japan and Italy. So when does this begin to really matter? And when do the bond markets and international investors say enough is enough?
And one of the changes has been the interest rate. If you go back 2 years, 4 years, 5 years, we were told by policymakers, don't worry so much about the deficit. It doesn't really matter, as you say, because interest rates are essentially zero or very close to it. They're not zero anymore. So what does that start to do about U.S. expenditures and our budget if we have to have that large a debt service?
I think at some point in time, it's going to start to impair other spending, including social spending, that because this cost is going to go up and up, right? That's what the bond market is currently pricing in, that we're going to have rates for higher for much longer. So at some point in time, then that begins to eat up a significant part of the total budget. And if you look at the cross-sectional evidence of what happened in other countries, once interest payments as a share of the total budget exceed a particular amount, then the pressure comes on to cut social programs. As I said, the central question here is this: when do international investors say enough is enough and they stop funding this kind of deficit? We haven't quite reached the point as yet because the dollar is still relatively strong. But at some point in time, I think we could reach that point, and that's when it really begins to count as far as the US is concerned, that you can't run budget deficits of 6% of GDP every year and have a current account deficit, which is 3 or 4% of GDP a year. A twin deficit of 10% of GDP a year, at some point in time, maybe much sooner than we think, that will begin to count.
Ruchir, there's a follow-on question, I think, to when do investors stop funding the deficit, which is if they're not putting the money into U.S. Treasuries, where are they putting the money? If you look around the world right now, some prospects, such as China, for example, does not seem to be as attractive a place for foreign direct investment. So where does the money go if it doesn't come into U.S. Treasuries?
Well, that's what's really helping the U.S., that it continues to be perceived as the best house in a bad neighborhood, right? Because you got, in terms of China in trouble, Europe, the perennial problem child of the global economy. It's the first country to sort of enter a recession, possibly even in this cycle. So I think that you're seeing some other signs of life in other places, like Japan is doing much better. It's done much better this year. I think some of the emerging markets outside of China have done relatively well. These include places like India, include places like Indonesia, Mexico, Brazil, and even some places in Eastern Europe like Greece and even Poland. These countries have done well. Still relatively small to absorb too much capital, but you can see that this sort of new era is beginning. It takes a while for this to happen. But I think that there will be a time, I think soon this decade, when you'll see a much better environment for international investing because the dollar stops appreciating. Currently, the dollar keeps reacting to the fact that yields are going higher. So it's like, okay, we must bid the dollar higher. Having said that, it's quite interesting that even though the perception is that the dollar is appreciating, compared to the increase in yields that's taken place, the dollar hasn't gone up that much this time. The dollar is still well below the highs it hit in September, October of last year, if you look at the DXY. So that's a sort of interesting subtlety, I think, which is lost in this debate here, that the dollar is not doing as well as would have been implied by the increase in 10-year yields here.
That was Ruchir Sharma, Rockefeller International Chairman. And in addition to that, Romaine, tonight we're going to have Zanny Minton-Bettos. She's the editor-in-chief of The Economist, on to talk about all that labor strife we're seeing here. And finally, Purnima Puri of HPS, talking about the effects on the credit markets of those higher rates for longer that you've been talking about. That's all coming up at 6 p.m. Eastern Time.
All right, be sure to tune in for that. And, of course, David joins us every day for his Wall Street Week daily segment right here on The Close as we wrap up the show with the push ahead in just a moment as what the markets are going to have their eye on next week. This is Bloomberg. A busy week up ahead for financial markets, including, of course, everyone watching that U.S. government shutdown.
Yeah, we'll see what happens over the weekend. But even if we do get the U.S. government shutdown, we have a lot of Fed speak to look forward to.
Are they allowed to still speak if the government shut down? Because I'm told Powell, Messer, quite a few of them are scheduled to speak.
Yeah, heavy hitters. You know who can speak is Jamie Dimon.
Oh, okay.
Of course, Bloomberg Television will be speaking to the CEO of J.P. Morgan. That conversation, 10 a.m. Eastern on Monday.
Yeah, you don't want to miss that. And you also don't want to miss our special coverage here of the start of the trial of Sam Bankman-Fried.
Yeah, that'll be pretty fascinating to watch, that kicking off on Tuesday. And then we'll see. But we're supposed to get a jobs report on Friday.
We're supposed to, which is sort of the key phrase there. But, of course, if the government shut down, we won't get that report. Take a look at the numbers, if you will, here. Maybe we find out what those numbers really are next Friday. Maybe we don't. But we really appreciate you watching us here on Bloomberg Markets to Close. Katie and I will be back next week. This is Bloomberg.